Yeah, it was good enough for a front row. So
That's amazing.
I was like, look, I obviously like believe a lot in my ability, but I know that being out of a seat for a while, like there's going to be a few cobwebs to kind of dust off. I didn't expect for it to go that good. So I was like, I was grinning from ear to ear.
Daniel, I ponied up 120,000 last week for the simulator, which is somewhat almost like what you, Max Verstappen, and others do. We see it on the Netflix movies. You guys are in the simulators wasting time from photo shoot to photo shoot. Explain what a simulator can't do. I'm fascinated by your leap from simulators to Budapest, which some people say is Monaco without barriers. What's the jump from simulator to actually doing it?
I mean, it's still a legitimate jump. You know, I think the simulators now are very good. Like the teams purpose build them. You know, you can't. These aren't simulators that you can have at your home. They are beyond next level. So they feel like you can kind of get. I mean, what I'd probably say it feels like maybe 80%, 85% of the real thing. So it gives you enough of a feeling and enough of an idea. So it definitely helped me get up to speed. But you know, there's no like physical aspect of the simulator. You know, you don't get the G-forces, and that's
the side forces, John.
So there's a lot that's still, you know, like tire management, all that sort of stuff is then that's all on track, real stuff that that I have ahead of me, obviously now this weekend. So it's prepped me, but yeah, I've still got a few things to get on top of.
Well, let's talk about this weekend and beyond. So you're obviously going from a team as a reserve driver, Red Bull, at the top of the pack, top of the standings, to a team at the bottom of the standings at AlphaTauri, back to your Toro Rosso roots. You know how to get it done in a slower car. So talk to me about how you're going to define success, not just for this weekend, but for the rest of the season.
I mean, it's really, I think, as you said, like the car I drove last week was the best car on the grid. So in a way, part of me needs to like remove that feeling. But getting into that car last week, I just kind of jumped in. I was like, let's just see how it goes. Let's just drive, use my ability, have fun with it. And, you know, that's the approach now. I think, you know, it's so easy to overcomplicate it. Yes, this team is having a difficult season. There's going to be some things we're going to have to work on, but I think the approach for me needs to be just go out there, drive it, and then we go from work on its weaknesses. And I think I just need to focus on getting the best out of myself first.
Daniel, I noticed at Silverstone that like Lando Norris is getting all the love. I mean, Florence Pugh wants to hang out with Lando, not Daniel. I get it. I mean, there's no question about this. You have been through the ups and downs of this. John mentions Budapest, and I think Austin's out there somewhere as well. Is this a sequential process you have to get back into it, or is this something you can figure out and practice to tomorrow, nail in the qualies, and get something done on Saturday?
I mean, I would say realistically, it's a bit of a process. I can't probably expect everything to fall into place on the first weekend, but let's see what happens. Like I also...
Daniel, I've never seen you this modest in my life. I've never seen you this modest in my life. Let's finish on this. Hopes and dreams, I know you've got many. Have you got your eye on that second seat at Red Bull? Not for next year, but the year after that.
I mean, that is where I would love to get to. And this for me it's an opportunity for sure back in the sport, back in the Red Bull family. And I know if I can capitalize on this, it could potentially lead to that. So this is all part of it.
Daniel, congratulations and good luck for race weekend. And next time you're in the States, drop by New York on the way to Austin and Vegas. We can catch up. Daniel Ricciardo there of AlphaTauri. Thank you, sir. TK, just very cool. going into race weekend?
You know, this is much to your heart and soul as well. And to me, it's the race course he's going to be on, which seems to be really challenging, really bumpy. The clear rap is it's a dry, dusty course. And once you're there, you can't be like Sergio Perez and start at 15 and go up 7 notches. So the tensions, just as I alluded to, it's in the practices, it's in the qualities here maybe more than
He
the
played
races.
it down, Tom, to go from the simulator to the actual car and put in lap times after something like 10 laps that would put you at the front of the grid.
Right.
It's just amazing.
Yeah.
It's amazing. And from what I understand, based on reporting, that the driver that had the other seat at AlphaTauri, literally 10 laps into Daniel Ricciardo testing, they made the call and sacked the driver and brought him back. It was that fast.
Well, and again, this is part of it. And you see it in the Netflix series, folks, as well. Let's review this, John. There's 10 teams. There's 20 chairs. It's not like Major League Baseball where you got 42 guys in the bullpen. I mean, there are
major
20
competitive
seats.
Yeah, next level.
It's more than tennis, more than golf, way more than golf.
Tom, you go from karting as a kid all the way through, and you hope, and some people can only dream of actually getting one of those 20 seats.
Before we came on, folks, we were talking to Mr. Ricardo here about Western Australia and the dust in karting. And that's where, these guys, someone like Max Verstappen, who is the Otani of F1, he's been doing this since he was 6, 7, 8 years old. They're not, can I state that they're not normal, even Ricardo, who's so accessible?
No, it's helpful if your dad was a racing car driver as well, like Max's dad was. You have to put a lot of money into this. How do we follow this? Stuart Kaiser, good luck to you.
Stuart Kaiser.
Stuart's going to join us shortly.
The G-forces
on the equity market. We'll get Stu's call on race weekend and hopefully on the S&P 500 as well. Futures right now, negative 0.1% on the S&P. Yields a little bit higher by 4 basis points on a 10-year, 379.33. A couple of names you need to look out for this morning. Netflix is down about 6% in the pre-market following earnings. The outlook for revenue, not so great. Tesla down 3%. Elon Musk committed to chasing growth and volume and not profits for now. From New York, good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The first half of 2023 has surprised us to the upside.
Can this AI and really Uber top-led rally continue?
There's a lot of disinflation in the pipeline.
We'd all like to see better balance, certainly in the U.S. market between tech and the rest of the market.
These names that have run up so much this year, I think you do have to be a little bit cautious here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Your equity market right now on the S&P 500, negative 0.1%. Some of the action is not in big tech, it's elsewhere. It's the home builders, the airlines. United doing nicely in the pre-market. D.R. Horton in early trading, absolutely flying. It's a beat and a raise from another home builder in America, TK, after a decent run of gains through 2023.
Many stories today about American enterprise. Those are some of the good stories. We've been alluding to the home builders and what United Airlines did in a blowout quarter. Johnson & Johnson, good as well. I'm going to go to Cleveland. Full disclosure, folks, ancient family connection here to the wonderful Key Corp. And the answer is they're not getting it done. Key Corp is flat for the last 10 years. They've done absolutely nothing round trip with all the bank struggles. And I'm sorry, John, coming out of this earnings season, you know, I'm talking about it's 2023 being the year of the roll-up, the zombie roll-up. When does the bank roll-up start? I'm just waiting right now.
You know who is getting it done? The airlines. American Airlines this morning, second quarter EPS 192. The estimate 159. The outlook, this is what they see now for full year EPS. Here's the range, $3 to $3.75. This was the range they'd previously seen, $2.50 to $3.50. So there's another one, TK.
Are you bringing this up because you're halfway back in the line at JFK and you're just trying to move up in the line? I'm trying
desperately to get concierge key at American Airlines. Put it that way, it's not happening.
It's not happening. What is happening is we'll pay attention to the earnings here and we'll go down the income statement, which matters. And we're thrilled that we've got Bloomberg Intelligence, among others, to help us out as well. Curve inversion, 103. That's my data story of the day, John.
Yields up 6 basis points on a 2-year, 482 on a 10-year, Tom, 379. Let's call it 380. Yields higher there by 4 or 5 basis points. We are a week away from a Federal Reserve decision, a week yesterday, and TK, we're anticipating potentially another hike from this Federal Reserve.
Another hike is widely anticipated, the then what as well. What I would focus on is the modeling of rate cuts, which I've always thought was silly, way out front, way too premature, and all of that's going to hinge on data. And as you mentioned earlier, we've had a number of wizened people fall into a camp that says disinflation, again, John, bringing it down to 3%. 4%. The then what is the big mystery to Jackson
You
Hole.
can find consensus on one thing, a few things, but here's one, that we're in a sweet spot for disinflation through summer. Max Kenner of HSBC extending his constructive outlook on risk assets as fundamentals, he says, are still supportive, and the support is likely to be sustained until late summer. With us around the table, Stuart Kaiser, head of US equity trading strategy over at Citi. Stu, good morning.
Morning.
We won't talk about Formula One and race weekend. We're going to talk about this equity market. Let's get straight to it. Is there a sweet spot right now for the data, for the incoming earnings too?
Yeah, I mean, I think on the data side, there definitely is. You know, you've had massive positive growth surprises. You know, the last inflation print was quite low, and we're kind of on a bit of an easing trend on inflation. And the Fed is, you know, seems comfortable hiking slower or being completely done. And I think if you put all that together for risk assets, that's been a really powerful combination. And I think, you know, one of the big things it's done is it started to get people to broaden out, you know, the types of equities they're willing to own and kind of dip their toe into that cyclicals part. You know, the home builders and airlines being two of the candidates there.
They've been flying massive. Huge gains year to date, the airlines, the cruise lines. Discretionary spend is going to be the focus. Tom and I talked about the resumption of student loan repayments later this year. Can that kind of consumption continue at this level to support those cyclicals?
That's the ultimate test, and I think that's why the back half of earnings is actually going to be quite interesting. When retailers start to report, what are we seeing from a consumer spending perspective, and what are they doing in terms of passing on price? I think the one good side is, you've added $600 billion to money market funds on the retail side over the last 12 to 14 months. Those money market funds are throwing off 5 to 5.5%. So at least you are getting an income from your investments that you previously weren't. But I think you've hit on the key point. If we're going to get a slowdown, it probably has to come from the labor side of the economy, and if that happens, what does that mean to consumer spend, which has really held up, the market and the economy year to date?
You're just if you're in the surveillance simulator, it's like Daniel Ricciardo. You're in the simulator right now, and you are way too modest about your success of having the courage to be in this market through this nascent bull market. You say we continue, but we continue without key rotation. That's a fascinating statement. What do you mean that we're not going to rotate it?
I mean, our view is you've had basically large cap tech and growth leadership on a year-to-date basis. And I think the question is, do people start to buy cyclicals such as energy materials, capital goods, maybe banks that have underperformed but have a lot more sensitivity to the economy?
Right.
They've been really hesitant to do that because most people had this, recession in their forecast and fear that the Fed may have over-tightened. As that recession risk gets pushed out and maybe even minimized, people are starting to get a little more confident and comfortable owning that cyclical part of the market. We're still a little bit cautious about it. I mean, we still have a recession in the first half of next year, so it is a little hard to jump in with both feet into that part of the market, but there's a nice setup.
But this is critical. At the margin, then, can you acquire shares today in tech kind of stocks, growthiness stocks, trading at 25, 35, and 45 multiples?
I think so. We're still comfortable owning tech and growth, Tom, to be honest with you. I mean, these are the parts of the market that are generating growth. Growth is scarce both in U.S. equities and globally. So we do think that part of the market can continue to work. Risk reward, clearly not what it was. I think there's certain stocks in that space that you need to, be a little careful of from a valuation perspective. But you look at even Microsoft last week, they make the good AI headline, stocks at 5%.
I can't emphasize, John, enough how Stuart Kaiser sticks out like a sore thumb here. Every legal beagle at a major Wall Street firm is saying, this is anathema. How can you suggest marginal purchase of 25, 35, 45 multiple stocks? And I think he just said, load the boat on LVMH.
I'm not sure he did actually say that.
Oh, excuse me.
So I know it's difficult to do single names with you, but help me understand how cyclical some of these tech names actually are. What's going to be exposed to the same trends you described that might hurt the cyclicals, that might also hurt tech too?
That might also hurt. Look, I think the more cyclical parts of tech tend to be, hardware and semis, right? And so those are the two parts of the market. If you're worried about a cyclical slowdown, you want to be a little bit more careful with. Unfortunately, right now, NVIDIA's in semis, and that's created a significant challenge. And Apple falls into hardware. So both of those areas, at the sector or industry group level, you'd be kind of worried about. But you have these very strong underlying single stock stories, and that's why earnings the next couple of weeks are going to be so important, right? These companies' valuation has expanded, sentiment's quite high. And not only do they need to hit their numbers, they really need to satisfy the sentiment, right? And they need to keep the animal spirits going in those stocks. So you could have a situation where they nail the number and the guidance or the discussion around AI, for instance, isn't quite as exciting as people would hope for, and the stock could come under pressure. So I think you have a really big test, not only for the EPS bit, but what do they say on guidance and to support sentiment to keep those stocks working?
The beat isn't sufficient, you need to raise too. We see that from Netflix this morning. Netflix is down 7%, subs through the roof, the outlook for revenue, not so great. I want to understand then from your perspective how you want to play this. Do you want to do it through a sector level, single name level, the index, market cap weighted, equal weight? What's the focus now?
Look, I think from our perspective, honestly, and generally speaking, you have two choices, right? You could be in your cyclical portfolio and you buy a put, let's say, to hedge that, or you're in a growthy, more defensive portfolio and you own some convexity to the upside if cyclicals start to work. So, as you know, our view has generally been to be in tech and growth. We think that's the core part of your portfolio. Right. So right now, you need to have something that if that cyclical market starts to take off, you can participate in that. And I think, the three biggest candidates for that would be capital goods, which is, highly cyclical, and industrials and has underperformed. And then energy and banks would also fall in there as well.
Let me translate this. Convexity to the upside is an acceleration form if you buy the cyclicals and then they pop and that adds to your total return. Can I get quote unquote convexity to the upside in tech?
It's a little harder right now. I mean, through the option space, you could probably get that. If you were going to do that, you're probably moving down the market cap structure within tech, right? So that's maybe like a NASDAQ equal weight. You stay in tech, but you're in your smaller software companies and some of these companies that maybe have a higher beta.
Can you get convexity in mid cap right now or international?
Yeah, I think so. And internationally, you can. I mean, we've seen people sniffing around China again. You know, we've seen some flows into EM equities. You know, Brazil was a big popular trade for the last couple of months because folks are expecting some rate cuts there. So you can find it there without a doubt. But look, it's a difficult market. This isn't an all-in type situation. This is being selective about the areas you want. And look, if you think of the setup in tech to begin the year, it was a valuation had derated. People had sold massively that sector, and sentiment was quite negative. I think you'd put both energy and banks in that same category right now. What we lack is the catalyst. In tech, we had a catalyst. We had earnings coming out and then AI that sort of triggered a reversal of that setup. What is going to happen in banks and energy to do that? OPEC hasn't worked. On the bank side, we had some comments from CEOs about deal calendar. I think if you got a lot of commentary about the deal calendar and M&A picking up, the banks can work. But again, so you have the setup you want. You're searching for the catalyst.
China?
We just haven't seen it. I mean, which direction is the China catalyst?
I know.
Well,
I was going to ask today of you, Stuart, is it going to be a headwind or a tailwind for growth in the second half?
Everybody knows.
Yeah, I don't think. Look, it looks like it's going to be, you know, a bit of a headwind for growth at this point. You know, based on the reported data we've seen. You have a Politburo meeting coming up. I think, you know, the people that are bullish China are hopeful that you're going to get some news out of there. You've had some single stock stories like Baba, you know, has been read positive. But generally speaking, I think at this point, you just hope China doesn't disrupt things. I think is probably, you know, the way that people are positioned there. But we have seen some incremental interest in China upside recently.
How has the conversation changed around the Federal Reserve? Does it come up as much anymore going into next week?
I would say that the conversation around the Fed has quieted down, you know, quite a bit. You know, the Fed themselves, frankly, was aggressively talking about FCI and equities being too high, you know, as recently as 6 or 9 months ago. And even they are not talking about markets as much. Look, I think the question here is it's widely assumed they're going to hike in July. You know, probably skip September would be the base case. The question, I think, is how do they message this? You know, I don't think they want to be seen as completely done with the cycle. And for that reason, they kind of need to hike in July, and then the communication needs to support that. If there's two things that people are really focused on, is one that Tom hit on, which is the cuts that are priced into 24. How do they message around that? And potentially, do they need to play with the longer term dots as a way to really message to the market that even though we're slowing the pace of hikes, we still remain, you know, on a hawkish posture?
And that's going to be a September call, right?
I love that.
Later this summer. Hawkish posture. Tom, you love the Fed game, don't you? Rate cuts in early 2024.
I want to go back to Greenspan. Here's a ham and cheese sandwich.
Can you imagine going back to the Greenspan years now?
No.
Once the paste is out of the tube, it's like, it's over. You can't put it back in, can you? Toothpaste out of the tube? Come on. Americans don't use toothpaste.
We say, I dream of genie out of the bottle.
Same thing.
Okay. We keep the toothpaste in the tube. That was all.
Stuart, thank you.
Brilliant.
That was meant to be the other way around, but all right, whatever. Stuart Kaiser at UBS, of Citi rather. Yeah. He's moved on.
I haven't moved on. I mean, Stuart Kaiser's channel, and you know, Daniel Ricciardo wants convexity at Budapest. That's all there is to it.
A lot of sport this weekend, Tom. You know, very cool. Looking forward to Premier League football coming back too.
You've ruined me. And of course, the great affiliation with Liverpool here off the Red Sox thing I did. But you know, I
saw you make some news on that. Liverpool Echo.
You know, I'm large within the
TK's
Liverpool newspapers.
Domestic UK local newspapers now.
Nice.
You know,
Daniel Levy's intern called me up and said, "What the hell is this?"
Home of the Beatles.
You know.
There we go. If you are just tuning into the program and wondering what on earth this is, welcome to the program. Equity futures on the S&P, negative 0.15%. Coming up a little bit later, Tom, we're going to catch up with Peter Churham. Looking forward to this from Academy Securities. We'll get our teeth into what's going on, not just domestically, but also, to Stuart Kaiser's point, in China. What on earth is going to happen there? Do we get that big stimulus shift? Is it going to be a tailwind for growth in the second half or a headwind?
Yeah, my camp is I would suggest they have limited choice. The choice set at Beijing right now is really small and is about employing people, including 20% plus youth unemployment, whether it's fancy middle, upper middle class youth in the Pacific Rim, or it's a staggering poverty and low wage across all of China. So their choice set's incredibly small here, and they're going to make those decisions as we go through it.
We get to one of your favourites in the bond market in about 15 minutes as well, Tom. Ian Lingen of BMO Capital Markets on interest rates, with a 2 10-year spread in the Treasury market at the moment at negative 103 basis points. We really haven't backed away from that, have we?
No, we haven't. It's an adjustment day with that economic data coming out at 8:30. We begin the housing coverage.
Jobless claims coming up a little bit later this morning. 1 hour, 15 minutes away. Tons of earnings out there. Starts to ramp up for big tech through next week. We'll go through the dates for you. Behind us after the close yesterday, Tesla, Netflix, United this morning, American Airlines getting it done, D.R. Horton getting it done. More on earnings in America coming up next.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Earnings season is here.
decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Certainly so far the worst is the classified document situation, not only because he had our nation's secrets hanging out at Mar-a-Lago and at his Bedminster Golf Club, and then he lied about it and obstructed the investigation and instructed his lawyers to lie and lied to his own lawyers. Those are some pretty bad facts that put a lot of loyal, patriotic Americans at risk.
That was Chris Christie, the former New Jersey governor and Republican presidential candidate, in a conversation on balance of power with Bloomberg's Anne-Marie and Joe Matthew. We're about a month away. August 23rd is going to be the first debate for Republicans to become the presidential candidate for the party. That's going to take place on Fox News about a month from now. TK, that's only around the corner. Just around the corner as well, more data in America. 8:30 Eastern Time, jobless claims. Going into all of that. Here's the state of things for you at the moment, starting with equity futures on the S&P 500. I'll give you a flavour of things cross-asset and then move to the single names. Equities are down about 0.16% on the S&P. Yields are higher by 4 basis points on a 10-year, 3.79. Dollar not doing much against the euro, clinging to 112. That currency pair at 112.02. Just to turn to the single names this morning. D.R. Horton, beat and a raise for the home builder in America. That name is up by close to 6% in the pre-market. American a little bit softer, seeing a modest profit for the coming quarter. We're down about 2% there, but ultimately still for the airlines in America, let's not allow that intraday move to shape the narrative for what has been a boom for airline stocks year to date, Tom. A boom for the travel industry, and not just for the airlines, but also the cruise line operators, 3 of which are in a top 10 performance stocks on the S&P so far this year.
The memory of an interview with Ed Bastian, I'm going to say 2 years ago, if not 3 years ago, and he was shockingly prescient about international coming to the rescue. I'm not sure he knew how it would come to the rescue, but to me, it's a huge international story. I mean, I don't see Southwest Airlines, JetBlue, or others giving us the kind of headlines we get from the majors.
No, and they need corporate demand now, Tom, to pick up after the summer holidays.
I want to get this one question into Emery Horton, our chief Washington correspondent. She is the starlet of Balance of Power and joins us this morning. Emery Horton, I'm lost, and explain to our global audience, the governor of New Jersey, Christopher Christie, I believe in a Bloomberg beautiful artwork I saw yesterday, has 2% polling. This is not Jimmy Carter in 1976. What is the hope and prayer for somebody like Chris Christie in your interview last night with 2% polling?
Well, I think there's two things. One is that he really has almost a mission in this race, and that is to what he wants to say, talk about the truth when it comes to the former president. It's difficult for some people for that to resonate, given the fact that he was an ally of the former president, but clearly he's not, and he's really one of the only few on this stage of Republican candidates that are really willing to go after Trump aggressively. Second, while yes, he's polling a little bit north of 2%, in New Hampshire, he's third with a 6% handle. That's where he's trying to spend a lot of his time. And he will remind you at what the polls were showing at this time in 2015. And at this time in 2015, Jeb Bush was north of 20%. And the former president, Donald Trump, was polling at 1%. So that's an historical statistic he really likes to remind viewers about.
Emery, I've got to go on to the breaking news. This is John Hudson and Isabel Kushtaveyan in the Washington Post. It's out there also in the Zeitgeist as well. We've reached a new stage in Ukraine. Admiral Stavridis joined Bloomberg Surveillance yesterday and was heated that we have World War I-like activity in the south of Ukraine. And now we learned this morning that Ukraine is using cluster bombs. Is this a new stage of infantry combat in Ukraine?
Well, it certainly is a new stage. This is something Ukraine wanted. They got these cluster bombs from the United States delivered earlier this week, and now the Washington Post says that they are being used on the battlefield. I would have to say the speed at which these cluster munitions were announced by the administration just about 2 weeks ago to then being used today is pretty rapid. This has obviously caused a lot of consternation for the administration because it is controversial, these cluster munitions. It was controversial at the NATO meeting I was at in Lithuania because about 2/3 of the countries on the NATO alliance are against using these cluster munitions, full stop. The issue, of course, the Ukrainians have, and the U.S. was able to see, and then in the end side with them and back them, is that Russia has been using cluster munitions throughout this war. And it has been difficult for the Ukrainians to fight back on these cluster munitions, between the Russians using cluster munitions and, of course, having all these landmines that Ukraine is trying to dig around to try to fight this war. Then the U.S. decided to send these bombs, even though it was very controversial. And now the Washington Post is reporting that they are being used. Of course, there's one thing we should note, and is that President Putin recently gave an interview for Russia State TV and talked about the fact that there would be consequences if Ukraine were to use these cluster munitions, of course, the same bombs that he has been using.
So, MH, let's put two stories together. Did you get a feel from Chris Christie, the former governor of New Jersey, as to how this topic, the war in Ukraine, will play out on the debate stage next month?
Well, he was pretty direct that he supports the U.S. sending aid to Ukraine. Again, he has been very critical of how the former President Trump has described and talked about Putin and this war. He does not think this is some sort of territorial dispute. He says this is a brutal invasion of Putin into a sovereign country, into Ukraine. And he was very supportive of U.S. aid going to Ukraine. This has been one of those issues that you've seen really a spectrum, and a wide spectrum of candidates in the Republican Party. You had so far on the right Mike Pence actually going to Kyiv. Chris Christie didn't say whether or not he would make a visit to Ukraine, but Mike Pence, very hawkish on this, went to Ukraine. And then you had Governor DeSantis call it a territorial dispute and then really had to walk that back and start to ramp up some of his rhetoric against Russia and for Ukraine. So this will be one of those moments where I think Chris Christie will come off on the more hawkish side.
MH, we know, though, that does not poll well with the party. You've seen that from Pew Research polls from the last several weeks or so. That might help you win the campaign as president, perhaps, maybe, if you want to run as that kind of candidate down the middle to bring two parties together. Is that going to help you win a primary?
I think it's in how they explain it. Because one issue you see in some of these polls is that their concern is about the money that is being spent to Ukraine, when at the same time at home, many Americans are feeling the likes of high inflation, higher grocery bills, higher gas. Remember last summer? These are things that are starting to ingrain in American consumers' mind, and that's when it starts to show up in the polls. So I think what you'd hear from the former governor and others that are hawkish on this is about the fact that you have to stand with your allies, and also you would not want this to spread. Similar message, though, we've heard obviously from the Biden administration. We should note, though, John, recently when there was an amendment for the NDAA on the House floor that would strike down some of that funding, it really won bipartisan support. So yes, some Republicans voted against that, but I would say still within Congress, there is bipartisan support from Republicans as well to send aid to Ukraine.
MH, thank you. Anne-Marie on the latest down in Washington. I mentioned that Pew Research poll, so let me actually show the results with you. Currently, 44% of Republicans and Republican-leaning independents say the U.S. is giving too much aid to Ukraine. Compare that to Democrats. According to this poll, just 14% of Democrats and Democratic leaners view the current level of U.S. aid as excessive. TK, there's a clear divide right now between parties.
The divide's already been there. Well, it's between parties, but it's also within the parties as well. And, you know, I've alluded to the silent majority. Maybe there's a silent middle of both the Democrat and Republican Party that's looking at a war. As I talked to James Stavridis yesterday, we talked about this idea that the U.S., America, is a history, John, like short wars. We don't do the 30-year war. We don't do the 100-year war. But we've gone from our short wars to Iraq, Afghanistan, and that's the real fear in Washington, is another long war.
Coming up on this program, Ian Lingen of BMO Capital Markets on interest rates at the moment, with yields pushing just a little bit higher. Equities on the S&P down by 0.2%. From New York City, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born. There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Live from New York City this morning, good morning. Plenty still to come. Data in about 60 minutes from now. We'll get to that in a moment. Let me give you a cross-asset snapshot of the market. Bonds, equities, what's happening in foreign exchange, and then we'll get to some single names. Let's start with equities now. On S&P 500 futures, negative by 0.16% on the S&P. NASDAQ, heavy tech weighting. We'll get our teeth into that in just a moment. Negative 0.7%. Dow's had a great run, Tom.
Dow's had a great run.
Great run.
Destin.
Russell's up too.
Carvana's
0.4%.
Carvana's the next member.
They're going to go into the Dow, aren't they?
The Dow.
This from Max Kettner of HSBC in the last hour. He thinks this can continue. We extend our constructive stance on risk assets. Fundamentals are still supportive. He expects they're going to be supportive until late summer, and that's when he thinks inflation starts to climb again. This is what the bond market's doing in anticipation of some of that. Yields are up by 5 basis points on a 2-year at 482, on a 10-year up 4 basis points to 379. We've got a curve that's deeply, deeply inverted. The 2-year, 10-year,
104
through 100 basis points again. TK.
And then moving, still moving this morning.
Ian Lincoln and BMO coming up shortly. Look out for that conversation on what's happening in that yield curve. Want to finish on foreign exchange. The euro against the US dollar at the moment, just clinging to 112. 112.04, that currency pair totally unchanged. Let's turn to some single names. And let's start with what happened after the close yesterday evening, starting with the likes of Netflix and Tesla. Tesla's down by 4.3% this morning. Elon Musk came on the call and essentially said this, Tom: it does make sense to sacrifice margins in favor of making more vehicles. We think in the not too distant future, they will have a dramatic valuation increase if they can, of course, do something with autonomous driving. So that stock's a little softer, but this is the challenge at the moment. You've had massive year-to-date gains on Tesla. Before today, up 135%. How do you encourage further gains with the earnings releases we're going to see over the next week?
Or you encourage stability. I mean, with the moonshot that we've seen in a bull market nobody believed in, maybe it's just time. It's time for a timeout to just rest forward and execute the business plan, whether it's Elon Musk or it's the others.
Let's keep that board up, please, and turn to Netflix as well. Netflix coming out with great subscriber growth. We'll talk about this in just a moment with Tim Nolan of Macquarie. Look out for that conversation too. But Netflix ultimately coming out with a pretty subdued outlook for revenue. The stock is down by more than 6%. If you want some good news, move away from tech and go to the cyclicals right now.
Move away a lot of ways.
Home builders, Tom, has just been phenomenal this year, and I think this plays into the rate story in a massive way. 5% rates at the Fed aren't the problem. They're the solution for home builders because people don't want to sell their homes right now and get a new mortgage. TK, D.R. Horton, home builder in America, beating a raise, a big one, up 3.8% in the pre-market.
The chairman, D.R. Horton, may disagree with me, but to me it's an elite play. It's no different than the airlines. These are fancy homes for fancy people, and that's the kind of economy that we're in right now. What I would suggest, John, and this is to come forward after the tech earnings and the earnings that nobody talks about, is a continuation of the great zombie roll-up that I've been talking about for 18 months. And what's interesting here is some of the nuances of J&J coming out today with really good numbers And they're doing a spin-off. They're taking this Kenvue. It's called, the symbol's some goofy thing, KVUE. And Filippo Falorni at Citigroup just gives it a rave here about legitimate organic revenue growth. Again, corporations adapting, and part of that is going to be a roll-up of the ones. Who rolls up the rest of the industry or on Netflix? To me, it's a complete mystery.
How are the others going to survive and make money with Netflix dominating?
Profitability is the heart of the
Who's
matter.
got the best position with the catalogue, the content slate, the pipeline, full content with the strike ongoing in Hollywood? I want to turn to the airlines. Let's finish there. United, American. United after the close yesterday, Tom, decent numbers from United Airlines, just riding the international travel boom in a major way. You talked about the new routes going on. I believe LA to Hong Kong coming in October.
And to
More
Tokyo,
come.
Tokyo and Japan. Chart Banner just got back from Tokyo, said it was spectacular. I mean, he's a vanguard. He's on the vanguard of going back there after COVID. But to me, what's so important in all this, John, is this underestimation in a interest rate environment that harkens back 16 years to Ian Lingen's Ute. What's interesting here is how corporations adapt. The assumption out there and the doom and gloom zeitgeist is we're all going to roll over and die with real rates where they are. Grizzled pros like Lingen go, maybe not.
60 minutes from now, jobless claims. Ian Lingen of BMO Capital Markets weighing in on the slew of economic data this week and writing this. With a 25 basis point hike now effectively priced for next week, the data continues to reinforce the notion the economy is holding up well enough to keep policy rates higher for longer through the end of 23. And here's the kicker, Tom, if not longer.
For Global Wall Street, our interview of the day with Ian Lingen on rates. I was making jokes about it, but Ian, you and I remember a normal rate environment. Mm-hmm. The pervading feel is we're all going to die. How do we survive in a normal rate environment?
I think that survival in this type of rate environment is going to be a function of picking your places on the curve. It's an attractive environment to be involved in bills. It's an attractive environment to be in the front end of the curve. But as we know, when that shifts, it shifts very dramatically. And I expect that things will look wonderful from an economic perspective, certainly in the context of what we would normally anticipate between now and the end of the year. But come the fourth quarter, we'll start to see more evidence of the cumulative impact of policy tightening.
To go to the belly of the curve, if you're at the 5-year point and you're rationalizing the risk of reinvestment, is your scale to go out to 7 years or is your scale to go out to 10 years from 5?
I think you go from 5 to 10 years, and I think that the logic behind that is that there is enough cyclical risk between year 5 and year 10 to justify lower yields over the course of time. And let us not forget, the 10-year Treasury is the benchmark of all benchmarks, and so for overseas investors, it will always be an attractive touch point.
Andrew Honhorst at Citi just published. He said, we see upside risk to inflation and downside risk to growth re-emerging in late 23. Max Kettner has been bullish this equity market, and I know equities aren't your thing, so I'm not going to go in that direction, don't worry. He's bullish and still bullish, but only through the rest of this summer. He thinks after the summer, inflation risk starts to kick back in. What are you telling clients about that?
So I'm completely on board with the notion that once we get to the September, October CPI numbers, that we'll start to get a better sense of how much housing costs and OER and rents have actually moderated sustainably. If we see a return of those core inflation components, I think that's going to be problematic for the Fed. It will push rate cuts even further into 2024. And more importantly, I think the Fed will focus on shifting the conversation to core services ex shelter. And that's the big uncertainty. If that, given its high correlation with nominal wages, continues to moderate, the Fed can claim victory even if core inflation resurges towards the end of the year.
Given what you've just said, how do you think that's going to shape communication next week and beyond in Jackson Hole?
So we're expecting a comparatively dovish hike next week. We get 25 basis points. That's completely priced in at this stage. But the Fed, yes, wants to retain a degree of flexibility, but also needs to communicate to the market that 550 may very well be the terminal rate for this cycle. So we're looking for a Powell press conference that echoes what we saw in June, not what we saw at Humphrey Hawkins.
Not because of you. It was in BMO Capital Markets, but I loaded up on the Austrian 2,117 piece. I thought for the great-grandchildren it would be a great idea. And I've enjoyed that from a price of 220 down to 75. And critically, it hasn't come off the mat at all. What's the risk to retail of being yield hogs in defining duration of 20 years, 25 years, 30 years? What's the risk that you see there that retail, they just love to go out to that maturity?
The biggest risk for that sector is that the subset of the market that believes that inflation is structurally higher and therefore nominal rates will be higher for longer over an extended period, that they're right. If inflation is structurally higher and the Fed gives up the inflation target at 2%, revises it to say 3%, then we actually are going to be in a sustainably higher rate environment for an extended period.
With all your work on the R-star debate, John Williams comes out and reaffirms lower R-star. Others, as you say, are looking for a higher R-star. Where does Governor Lingen think we are?
I think that the post-pandemic period, we will all come to the realization that R-star hasn't changed. If anything, it's incrementally lower as a result of the dislocations.
We could do a co-interview here. We could do
you want Williams
Lingen
on?
and Williams together.
Williams on?
No,
Jackson Hole, Wyoming next month.
No, this is serious, folks. We got market guy here saying he agrees with John Williams as well. What are the high R-star, the worry warts? What do they get wrong?
I think that the argument breaks down once we see labor force participation continue to move higher across the board, with the exception of 55 and older cohort, and we see nominal wages revert to pre-pandemic norms.
Like, give me a statistic that's critical there. On nominal wages, let's say we had the luxury 4, 5, 6%, particularly the lower deciles. Where do we get back to normal on nominal wages? Sub-inflation?
So if we're printing with a 3-handle sustainably year-over-year average hourly earnings, the market is very quickly going to move back from the higher R-starred argument.
Pre-pandemic economy, is that what you're calling for?
I don't think that much has truly changed.
Really?
I think that the Fed got transitory right. What they got wrong was how long transitory applied for.
And you can't say that. You know you can't say that.
It was 4 years.
Okay, let's go back. Little experiment. What do you think the optimal policy response would have been given everything we know now?
If Congress and the fiscal side had stayed out of it. I think that the Fed did the right thing. It was difficult for Washington at that moment to not pump a ton of money into the system. I think that that is what really shifted the realized
That was the ultimate
inflation.
sin. Yeah. But what could the Fed have done? Given everything we know, just the benefit of perfect hindsight, 2020 vision, what could they have done?
They could have stopped buying bonds sooner. They could have normalized rates more quickly. But recall, what the Fed was doing was they were trying to make sure that the system continued to function, that the ATM card worked when you went to the bank. And so they were playing a much longer game than the market was.
Ian, good to catch up. Ian Lingen there of BMO. TK, transitory, just extra transitory.
No, this is. I'm going to go back to modern. I'm going to go back to modern monetary theory, and you can't say that Congress legislated a pandemic and Congress gave us, as Olivier Blanchard calls it, the Biden stimulus. Somebody gave us the stimulus, and the institutions, not just the Fed, had to deal with it as well. John, you know I'm clearly in Mr. Lingen's camp on this, but the answer is it was not perfect policy. I do think the adjustment was a little bit tardy, but that's all 2020 hindsight. It's like looking at Daniel Ricciardo this weekend and trying to game out the crystal ball what he's going to do.
Yeah, there's just one wrinkle in that argument, and I think Ian made the right point. A lot of people were screaming end the QE. It wasn't like this sort of
the balance sheet debate,
out there contrarian view.
The partition this is important.
They were so slow.
The partition of the balance sheet debate versus conventional FOMC debate was understated.
If you are just tuning in, welcome to the program. Equities on the S&P
relationship going
negative by 0.14%. Equities right now just a bit softer. Yields a bit higher, Tom, by 3 basis points. When is our next therapy session?
We're not doing those anymore. We're trying to get.
Is Daniel Ricciardo coming to that as well?
No, we're trying to get in with Anne Hathaway.
I was impressed in that interview, Tom. You didn't call him David. That was good.
I did.
That's
an
improvement.
Well,
did you practice that last night?
No,
this morning?
I did. I practiced it all night. He's had, David Ricardo and William Stanley Jevons had, from Sydney to Perth, they had a fundamental impact on economics. The economics for him. Can you imagine if he does well this weekend?
I'm not sure what I still don't know what doing well is in an AlphaTauri. What is that, scoring points?
He qualies
scoring
at 12.
Points, clearly, that's
no,
pretty good.
No, he qualies at 12 and ends up at 8. That's a success.
Yeah, that's a great race weekend. That was great.
It's great, and I'm working on it.
When is quali?
Quali's Friday. It's in the morning at 7:30.
Oh, so is there a sprint race? Is there a sprint race
No,
this
it's
weekend?
on what we're on.
Okay.
We're doing Big Little on it,
Didn't know that.
We're doing Big Little. The 4K screen looks great. We're gonna have us here and down Teen Suites. We're gonna have qualies.
I wasn't aware of that.
Yeah.
Okay, I'll check the calendar again. We're going to talk about Netflix in a moment. Tim Nolan of Macquarie on Netflix. Netflix down in the pre-market. They've come out with massive subs relative to expectations, but the revenue line, a little bit confusing for some people out there. So we'll talk about that in just a moment, TK.
I'm going right to profitability.
Yeah, and the competition too, and the strikes, the writers' strikes in Hollywood and beyond. From New York City, this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Oh, Spencer Newman, the Netflix CFO, following results yesterday. Subscribers, big beat. Revenue, something to talk about in just a moment. The stock is down by 6.2%. I think just an example this morning, TK, of how difficult it is to validate big gains year to date. That stock was up 62% before these numbers dropped, and then add a little bit of fuel to the rally for the rest of the year.
It's going to be interesting to see. We're going to get right to it right now. What we do at Bloomberg Surveillance is we talk to experts. Timothy Nolan is at Macquarie. He looks at the media business and particularly the silliness of Netflix, which John and I both missed, the big bull market move. Tim, I'm going to go to Gwendolyn Christie, who hit the ball out of the park in Game of Thrones. She shows up with a TV script on her desk. She does this thing called Wednesday. And all of a sudden, some kids trash at Netflix called Wednesday and Wednesday Addams, they absolutely hit the ball out of the park. How much is Netflix beholden to finding the next Wednesday Addams?
Well, it is still a hit-driven business, isn't it? Just like the movie business always has been. You know, the streaming business
perhaps ironically, given how big the library is and how many shows and movies are always coming on, it is a hit-driven business. No one saw Squid Game coming, and that, I believe, is the #1 watched show of all time on Netflix. So the good thing for Netflix, of course, is they do have, a big production pipeline and lots of big shows coming, and they do seem to generate hits at a pretty consistent basis.
Can you give them a persistency of cash flow of a quality stock, even though they're worried about the next Queen's Gambit?
Well, the stock had a big run up into this Q2 result. What I found a little bit puzzling about the result was that the number that investors seem to most look to is net subscriber ads. And that was the most important number to consider, especially this quarter, given the launch of the paid sharing system in the US. And as we found out, 100 countries around the world. And that was a good number, 5.9 million global net ads. That beat sell-side consensus. Maybe it didn't beat buy-side consensus. But, the revenue performance was actually on the light side. And that I think was the main concern amongst the analysts on the call was the ARPU or the ARM. The revenue per user was down in all regions, including US and Canada, which was quite surprising. But to your question, the free cash flow was strong. The guidance actually is even higher. It's now nearly $5 billion of free cash flow this year. Some of that is strike induced, as in some cash flow savings without production going on, but that number could actually trace back again next year. So kind of all in all, you've got a very mixed report, I would say, from Netflix, some good balanced by some uncertainties.
Tim, can we dig into that just a little bit more? At first look yesterday, I was confused by it. How can you beat subs by that much and then come in light on revenue? How does that work?
We struggled with this, and I think a lot of the sell-side community was struggling with this last night as well. Part of the explanation is that outside the US, in I think it's over 100 international markets, Netflix actually cut price not too long ago. So that is still working its way through. So, a lower average price simply means a lower ARPU or ARM, as they call it. The confusing bit was that the US and Canada was also down. And this is where they launched the paid sharing plan on May 23rd, which basically, if you get the account owner to add you on, contributes an extra $7 or $8 per month from that member. And then anybody that doesn't ask their account owner to add them can go on and take the advertising plan, which is at least $15.50 per month, which is higher than the base plan. So it seems like that UCAN number should have gone up. Maybe a little bit of Canadian foreign exchange brought that down, but it's not really clear to me why that number was down.
Still not clear to me. One thing is clear, that most people in the analyst community right now, Tim, think that these strikes are a non-event for this stock, for this company. Are you one of those? Do you agree with that?
If you told me the strike will last one more week, then it's a non-event, correct. If you tell me the strike's going to go for 6 months, then it becomes an event for Netflix as well as everybody else. Now, the reason in the short term it doesn't matter so much, of course, is Netflix, as I said before, has a huge library, a huge contribution from international production, which is unaffected by Hollywood. But also just a very long pipeline. I mean, it takes at least a year, up to 2 years to make a TV series. So anything that was due to come on in September is probably already ready to go. So short-term effect, minimal. In fact, a little bit of, free cash flow bump up because of lack of spending on programming, but that's not really the point. The longer the strikes go, the more the production pipeline is frozen. And then the more you're pushing out the issue into whatever future periods when you've got a lull in production over whatever next year or so.
Tim, I got to run an audible here on you right now. You mentioned Frozen, so let's let it go, let it go. Warner Brothers Digital, you got a pop to 22 on it. You're hugely bullish on WBD. Is Zavlev going to let CNN let it go? He's got 57% debt. It's do something for Warner Brothers Discovery. What are they going to do?
Warner Brothers Discovery, I think, has an interesting opportunity to create, let's call it the next large all-purpose streaming service, right? You've got HBO content, Warner Brothers studio content, Turner, which includes, I believe, we'll have a good deal of sports coming onto that, especially if the NBA contract gets renewed in a couple of years' time. So it has an opportunity, in addition with strong global brand and distribution, to become a major streaming service along the lines of Disney Plus, Netflix, Amazon Prime. So I think it has that opportunity. The debt is a concern for a lot of people. It's levered at 5 times. They are taking steps to reduce that through some relatively minor asset sales. There is some debt pay down coming, which I believe they can handle. The weak ad market is, of course, troublesome for that. But this company does have a history of aggressively paying down debt when it does deals. And I think if they can get through this, you know, the stock is looking really quite cheap here, considering those overhangs in the near term. So good long-term potential. If they can get through this near-term shaky period, which I believe they can, I think the stock is attractive.
I mean, it's attractive here, and it's also lessons learned. What has Mr. Zavlev learned, not so much with Ed Ludlow up at Sun Valley, but what's he learned in the last 12 months to reduce the debt and drive the business plan you described forward?
Well, you know, I would say the debt load, of course, was raised to take on the Warner Media assets. At the time, the ad market was strong. The expectation was they would generate X amount of cash, be able to pay down that debt. And the debt is laid out across lots of tranches over many years. Maybe to your point, one lesson being learned is this is a major, major undertaking to put these two companies together. It's a different kind of business, I would say Warner Media is, than Discovery and when they acquired Scripps had been. Different type of content, different demands, different viewership trends, all of that stuff. Putting all of that into one major, major enterprise with a lot of debt, a lot of cost cutting, a lot of things they found that weren't right going on inside of Warner Media when they lifted up the hood after they closed the deal. It's just been, I think, a lot to manage. And yet I still think the asset base and the opportunity is large if they can get through this near-term period.
Tim, you should go. Tom's going to start singing. Tim Nolan there of Macquarie. You done with that? Where did that come from? Let it go.
He said it was Frozen.
Do you know the words?
Yeah, do I know the words?
You know the words, don't you? How many times have you watched that movie?
Well, you know, the worst part of it is you have a 5 or 6 year old and you're completely transfixed and everything has to do with
It's just on every day.
And everyone. And then Vet Bill picked up on it, so the dogs watch it
They're
as
like
well.
barking to it.
Yeah, it's sort of like, you know, I mean,
Torture.
Lisa's doing
That
the
sounds like
Norway to
torture.
Greenwood. I mean, you mentioned it. But the fjord thing here, you know, in Norway, I mean, Bramwell's over there looking at fjords and going over to Spitsbergen and Svalbard.
I've got no idea where she's going.
And all
I can
that.
tell you this. You've confused Hungary with Belgium. Can I just go there quickly? No sprint race this weekend. I had a look.
No, and there's no
at the
sprint race.
schedule.
No,
But I
there's
thought you
just-
said there was a sprint race.
No, there's practice and qualies.
You said quali was tomorrow.
No, we have it is. I think
Practice is tomorrow. Quali's Saturday.
Oh,
Race
and
day
the
on
race is
Sunday.
Sunday. I'm sorry. See, you're the
Yeah,
pro. I'm the amateur.
Well, you confused me.
I was going to watch quali while we were on air.
Sprint race at Spa in Belgium following week.
Okay, they're in Belgium the following week.
So we can watch practice tomorrow. I think we'll do that together.
We'll watch it together.
You come
on
round
air.
on
Join
Saturday
us.
and
We're going to
watch.
go Big Little. We'll have practice.
You want to
on.
come round Saturday and watch quali together? We can do that. No, up to you. We'll have an early drink.
Have
Peter
a
Schiff
Swan Lager and
of Academy. You bring the beers and I'll make it happen. Great. Sounds good. Futures, negative 0.1% from New York. Peter Schiff of Academy, up next.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
When we think about how long the market can ride on momentum, quite long.
The view of our macro research team is that we get a slowdown and not a recession.
There's a limit to investors' comfort with over-leveraged, deteriorating fundamentals.
We're not taking a recession out of the cards 100% at this point.
I think the probabilities of a hike after July are probably somewhat higher than the markets are currently expecting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It's Earnings Central here at Bloomberg. We welcome all of you this morning. Yes, we're looking at the Fed. We're looking at further curve inversion. OMG, 103 basis points, red and green on the screen. It doesn't matter. I'm looking at East West Bank Corp and Acacia Research and Pivotree and Twist Bioscience.
What's happening?
These are the companies that we don't talk about. And, it's a Lori Calvasina world. And the answer is there's all the big names we can talk about this morning, including the smart conversation we just had on Netflix. But it's just we're now into the thick of it after the bank idiocy. This is a big deal.
I always say pick a stock, tell a story. You can pick a regional right now. They're attracting deposits again, but it's costing them more money. They've had a difficult year. You look at just the regional banks and you would say this economy is struggling. That's a story. If you want to pick out the home builders and you would say, well, this economy is absolutely booming. I think the home builders are one of the most fascinating stories in America and the American economy in 2023, by far. If you'd said to someone 12 months ago that 5% interest rates at a Federal Reserve wouldn't be a problem for these guys, it would be a solution because it would suffocate supply of American housing because people would be unwilling to sell their home because they were sitting on such a small interest rate on a 30-year mortgage that the home builders would be riding a monster wave. The home builders flying. D.R. Horton this morning out with a beat and a raise, and it continues. That stock is higher in the pre-market.
30-year mortgage, 7.15%, just down from the high point as well. And John, you and I follow this, folks. I look at the 4% level, which is where John was 3 months ago, way out ahead. And the answer is that some 70% of mortgages are set under 4%, and under 6% away from the 7.15% is 90. It's a ginormous number of American people saying, I'm happy.
What's going to change that supply-demand backdrop?
Policy. The only way it's going to happen is some form of original banker adjustment led by, I'll pick on Bank of America, it could be somebody else as well, but other than policy adjustment, I don't see it. What's the policy adjustment of United Airlines? Business is terrible.
I know.
Terrible.
International is
4 million
booming.
flights canceled as well. You can't get a seat. That's what I know.
Yeah, what's good for the stock isn't good for the consumer. Can we say that? I think we can say that.
I think we can say that.
Discretionary spending. We've talked lots about the airlines, talked lots about the cruise lines. Look, things are in a sweet spot right now. Consensus is they remain in a sweet spot through the summer. That's the consensus view, not my view. It's just the consensus view at the moment. You get deeper through summer, that consensus view starts to crack. Let me give you 2 quotes this morning, one from HSBC and one from Citi. Max Kettner at HSBC thinks the support is likely to be sustained for the equity market until late summer, and then inflation starts to climb again. Andrew Hollenhorst, Citi, the next few months are likely to look like a soft landing, but after that, quote, we see upside risk to inflation and downside risk to growth re-emerging in late 23 and early 24. The summer's not really a debate, Tom. Maybe it should be, but right now it's not. Later on after the summer,
huge mystery.
That's where the division is at the moment.
For those of you younger, we used to do 3-year plans. We believe 1 year from now. Nobody's doing that right now. Johnson & Johnson, dog of dogs for 15 years, a 10-year track record, single-digit total return performance. I didn't realize this, John. I'm getting a 5-year dividend growth of 6.02%, and I'm clocking a multiple of 15 or 16 on J&J. And that's what so many of our guests talk about. Are we going to rotate from Apple to Band-Aids? That's the key thing.
From the likes of Tesla, Netflix, and
whatever.
to discretionary and beyond to cyclicals. Can the rally broaden out is the simple way of asking that question.
That's very good.
Away from the dominance of big tech.
It's like equity guy.
Where is Bramo?
Bramo's off Norway somewhere. I don't know. She's,
cruising the fjords.
Yeah, well, no, I think they do the fjords for one day and then they go over to, I can't pronounce it correctly, Svalbard.
Oh, they're bouncing around.
They're bouncing around, and they go over, and it's like, it's not like, you're sitting with a rum toddy in your hand looking at the fjords. They're out there with the full, she's got the full regalia on. They're looking for freaking polar bears.
She strikes me as the kind of person that goes on that kind of vacation.
She's got the crampons.
Around the Nordics.
The spiky things.
Yeah, the spike things to walk on ice.
Like you were at Davos, those.
Yeah, or not.
The answer is she's off with the polar bears. That's what you do.
With the family?
I don't know if they took the family. I think it's too risky for the family.
I thought the bears were the family.
No, the kids are farmed out to some camp somewhere. I mean, she just, June 26th.
Bramo, I'm told, is going to be back for the Fed decision, so...
We made her come back, and then she goes back again.
She's going off again?
Yeah, she goes, comes in Wednesday. I think Friday morning she's back to Norway.
I believe it's Thursday. For a moment this morning, I thought it was Friday. We're having too much fun. Equities on the S&P, negative by 0.15% on the S&P. Tom, yields up by 3 basis points. Your 10-year, 3.78.
It's going to be interesting to see, to say the least. Right now, and this is important, as we just talked to Ian Lingen, hugely acute on the bond market. We talked to someone more conceptual and just as wonderful. Peter Scheer joins us, head of macro strategy at Academy Securities. As John mentioned, there's no visibility, Peter Scheer. How do you get out beyond Labor Day?
I think it's difficult. We've got to get through the summer jobs numbers. I think we're going to see some headwinds on the job numbers. I actually think we're going to see some deflationary pressure. So that's going to kick in, I think, into the fall. Right now, it's all about earnings. So far, I think they'll come in fine. I think we're going to see this rotation where the laggards get bought. Part of it driven by some of the index rebalancing that's going to go on Friday. But partly, I think people are finally seeing this trade work. So you want to own the Russell 2000, you want to own the laggards, and I think you're going to see some underperformance. So I think that's the trade for August, and September is going to be unclear.
The unclear of it all redounds to nominal GDP, a statistic for real GDP plus the inflation overlay on top of it. Are you constructive that the machine can continue to develop 4% nominal GDP per year?
Yeah, I think we can get to 4% nominal GDP, but if we're interest rates are at 5.25%, the Fed's going to have to do something, right? I think we do not want real rates above 1%. So if we start seeing nominal GDP tick down, and I think it's going to be a function of slower overall GDP and less inflation, that's what's going to try and drive the Fed's decision into late this year, early next year. Though for the next 3 to 4 months, I really think the Fed's a non-factor. They'll hike in July, and then that's about it.
Let's stay in that sweet spot next 3 months. Let's work through that together, Pete. You've shifted away then to the equal weight, I believe, from the market cap weighted call on the S&P 500. Pete, what changed for you that ultimately got you round to the view that this can broaden out?
You know, I think for the last little while, you're starting to see some of the leaders not do quite as well. And you're starting to see the story broaden, right? If we are going to get some sort of a soft landing or some sort of period that's not imminent recession, I think those laggards have to be bought. That's where people are going to look. That's where the value is. And even on conceptually AI, right? If AI is really going to work, it's going to work for individual companies as they figure out how to be more strategic or get efficiencies on their strategy, on their tactical level. So I think you're going to see this chasing of that. It's been a problem trade. I'm a little bit worried it's consensus. I think people have been piling into this trade for the last month. It has not been working. But I think we're kind of poised with this earnings, this rebalancing that's going to occur on Friday, that we can finally see this catch up.
Do you think that spreads, Pete, just to build on that, do you think that optimism, constructive tone around the equal weight, and sorry for speaking over you, I was eager to jump in, Pete. Do you think that spreads from, I know you don't, but you're rude, I'm not.
Yeah, okay, thank
Do you think, Pete, that spreads from equity to credit? Because high yield spreads are still pretty darn tight going into all this.
Yeah, I think credit's going to help lead the way, right? I think you're going to see credit spreads continue to grind tighter. You know, there's a lot of fear every once in a while. People are talking about this wall of debt maturities in the high yield market. I think right now it's still providing attractive yield. The overall quality of issuer is better. The banks have been getting rid of some of their kind of hung inventory, some of their bad commitments made, you know, during the peak. And with lack of supply, especially in the IG side, I think spreads grind tighter. That's very supportive. And if high yield spreads can go further tighter, that does tend to tie really well into a rally in the Russell 2000.
So, Pete, constructive on stocks, equal weight and small cap at the end there on the Russell. Constructive on high yield credit as well. Here's a risk factor. Real estate. Can you just weigh in on commercial real estate, Pete, and why you don't think that's going to be a broad problem? You think it's going to be a local, regional problem?
Yeah, I think it's going to be very local. You're going to have areas, I think, like San Francisco, where there was a lot of money invested at the peak, where work from home is going to continue. As people start seeing a little bit more pressure moving away from work from home, I think that'll help some of the CRE space. Plus, these things do take time to, you know, bleed out. And even want to tie back to some of your comments earlier about home builders. I think the one thing that doesn't get talked about enough about the home builders is this trend of where people are moving. So home builders can do very well when people are moving to new areas. And so that trend away from some of the cities into other regions really helps home builders. So I'm looking at more and more, I'm trying to get down in the economy, looking at it region by region, because I think we are starting to see the separation. And that's one thing, if you kind of caught that on home builders, you would have seen, oh, with everyone moving to Tennessee, Florida, Texas, there's a great opportunity for home builders, even with higher mortgage rates. So I think that translates very similarly into CRE. There's going to be some problem areas. There's going to be some good areas. But even the problem areas are going to take longer to play out, I think, than people expect.
So tell me the trade. Is that long Texas, short New Jersey? What is it?
You know, as a contrarian, I want to start getting long the other stuff. So I've been long some of these CRE stocks for a little while. I've been pairing gains in that just because, you know, everyone was so doom and gloom. And I think that's one of the things we look at when you know, everyone loves to talk about the great financial crisis. That took years to play out, right? It took a long period of time. I think it was the summer of 2007 when Merrill Lynch had to cut the dividend. And it wasn't until October 2008 that you had Lehman moment, quote unquote moment. So I think people got a bit ahead of themselves. Banks have a lot of leeway to figure these things out. The companies themselves will work it out. There's a lot of pressure, I think, to move a little bit away from work from home to back to work from office. So that's kind of why I'm constructive there for now.
Everyone's so harsh on New Jersey, Pete. You notice that, TK?
Oh, yeah.
They give New Jersey such a hard time.
Yeah.
I've never understood that.
It's always, well...
Everyone loves the Hamptons, but Jersey Shore is... What's that about? I still don't get it.
It's like snobola. It's
like massively.
Yeah.
Like the beaches at the Hamptons aren't that nice.
Yeah.
I
Stephanie Rule, when you start in on this, Stephanie Rule's hair curls. She gets so
likes
angry.
the Jersey Shore.
She's all Jersey Shore. I mean, she's got like 6,000.
One of our clients. Oops.
She's got like 6,000 square feet down there.
Okay. I think Pete wanted to jump in then. Pete, you can jump in by all means.
I was going to say, one of our clients has always wanted me to use the term Jersey math on live TV. I still don't know what Jersey math is, but it seems like an appropriate time to mention it.
Do you get money for that? Do we get a share of that?
Yeah, I think so.
The guests
I don't
that
know.
come on
Hopefully, I will get a shout out.
the guests that come on and they have a bet and they have to say a word. You know those guests?
Yeah.
I didn't realise Pete was one of those guests. Peter Cheer of Academy Securities. Pete, thank you, sir. If you are just tuning in, welcome to the programme. Your equity market on the S&P 500, just a little bit softer. We're negative here by 0.2%. That was Peter Cheer of Academy Securities. Coming up very shortly, we'll catch up with Steve Trent. Looking forward to that. Of Citi on the airline earnings, TK, just around the corner.
Yeah, Steve Trent is very good at this. These are acute notes about what they're doing and not what the headlines say. I think it's one industry where there's more, like you mentioned earlier, the separation of the business plan and the financial statements from the emotion in the media can't be any greater than in the airline business.
You want to talk international, I know, and United.
Well,
and how American also gets in on that.
I think the others are leading the way. I think you're going to have this, huge. I mean, my amateur take is there's a cyclical history of everybody on a board. We're going trans-Pacific, the romance of it, and all that, and then it's oops, there's too many flights, too many seats, and that's sort of the.
Well, they've been so disciplined about capacity, aren't they?
That's the new thing. Robert Crandall on this show many times. Good morning, Mr. Crandall, Mrs. Crandall in Florida. He said it. He said there's a new discipline out there.
All right. Look forward to that. Peter Hooper of Deutsche Bank coming up shortly. Looking forward to that conversation. Equities right now on the S&P negative by 0.2%. The airlines in America, that conversation
next
is coming up next.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
There's more upside to the economy than not, but we're growing above potential. And that means that whatever unemployment rate increase you see sort of bobbing around 3.5%, I mean, it's probably going to be short-lived. We're not on a situation where we're going to see above 4% unemployment.
That was Neil Dutter of Renaissance Macro, live from New York City this morning. Good morning to you. On the S&P 500, equity futures look a little something like this. Equities are negative by 0.2%. Tons of earnings out there. We'll get to the airlines in just a moment. Yields are higher by 4 basis points, 378.94. In the commodity market, crude is higher by 0.2%, 75.50. Tom, wheat prices just absolutely surging.
Yeah, we haven't talked about this
over the last 3 days.
Thank you.
As you're aware, the US has warned that Russia has laid mines at Ukrainian grain ports. There is huge concern about supply out of that country now.
I'd watch markets because markets watch not the speculation, but the tangible news flow out there, as Henry Horton briefed us on earlier. And I really want to emphasize the people off the radar on this. This is an active story in Ukraine. At this hour, Admiral Stavridis was with us yesterday. The force of his language about the to-do list for America as Ukraine devolves in the South into World War I-like warfare is tangible.
And just to squeeze in this headline from Ukraine just moments ago, the ships heading to Russia, Black Sea ports, maybe targets. That headline, Tom, just dropped in seconds ago.
We'll move on, but this is something we'll watch today and look for balance of power tonight, where I'm sure Mr. Matthew and Ms. Orden will brief us on Ukraine and on the American response. This is a joy right now. Steve Trent is known for writing acutely detailed change notes on the airline business out of Stuyvesant and Penn, holding on the Dartmouth bubble for 4 years or whatever. I think he took Tuck into a 6-year program just to hang out with his LL Beans on up in Dartmouth. Steve Trent of Citigroup joins us this morning. You learned at Tuck under Matt Slaughter and the rest of them that business plans matter and strategic vision matters. Which United States airline has the best Tuck-like business plan?
Well, first off, thanks for having me on and for the warm welcome. I super appreciate that. When we think about the U.S. airlines, I'm impressed with Delta. And I also think that United knows what it's doing in terms of its long-term fleeting efforts. And Delta Airlines as well, I would say both of them, what we're seeing on international long haul, that's really the place where I think 1 year from now, we're going to be talking about how good the unit revenue is. And those two carriers, I think, look very well positioned for that longer term upside. And I think their strategy on that regard has been intentional.
Steve, why isn't American in that sweet spot?
You know, in American's case, they have definitely done a better job. You know, the 2Q print was above the street. When we think about how they're set up structurally, they just don't have as much metal on those transatlantic or trans-Pacific exposures on those corridors. So they won't have as much as the upside. You know, you can kind of also dig down deeper, for example, into co-branded credit card and loyalty. That's a piece of the pie that elements of the market ignore sometimes. And if you look at Delta's program with American Express, what all of that telegraphs in terms of Delta's strength as a counterparty, you know, that revenue is still really surging in the right direction, and American, probably from a counterparty profile, doesn't get that same premium that Delta and United do.
So, Steve, when I see those massive lines around the corner at JFK to get into the Delta Airlines lounge, are you telling me that's good news?
You know, that might not always be the best news for the consumer. That's probably good to very good news for the shareholder. And I think when we look at the normal post-pandemic world out there, you know, I think Delta's been really good, and United as well, about really optimizing sort of the passenger outreach. And
let's optimize this, John. What we need in the lines you're in at JFK that go 4 miles long, we need Bloomberg terminals along the way so the shareholders can get their quotes along the way. Steve Trent, what I love about your note is you get granular about looking at weeks and months. You mentioned that October looks pretty good. Is your belief in guessing revenue, guessing number of fannies in the seat, Is your belief like it was pre-pandemic, or is there still a mystery to it?
Oh, that's a great question. And I would say that it looks like demand patterns have at least modestly changed versus pre-pandemic. And this is partially a consequence of many people no longer working in the office Monday through Friday. So that lifestyle adjustment per se, we believe has influenced the way consumers make purchasing decisions and the way they make decisions about purchasing airline tickets. So when we look at the data through October, the booking curve in this first batch of data we got for October looks very good. And one of the things we've seen in the last year and a half, quite frankly, is advanced bookings much stronger than they used to be pre-pandemic. We think that's one sort of symptom, so to speak, of the nature of post-pandemic travel is now a bit different than 2019.
Yeah, Jane from Scotland emails in and says she hopes you're working 5 days a week and not doing the work from home ballet. Steve Trent, when you look at the aviation business, and I'm going to go back to the wonderful conversations I had with one of my heroes, Robert Crandall, who basically invented, some would say, the price discrimination of the cabin. Is it going to be business as usual? Or for you out 3 years or 5 years, is there an airline new world, an airline new persistency of free cash flow that makes it more quality than the crazy Crandall world we knew?
Yeah, absolutely. So I think one of the things that's definitely going to be different for a while, it's capacity. So some of that's coming from the manufacturers. You've had, of course, these pandemic era supply chain issues, which there's some indications that those supply chain issues are improving, but there's still a lot that they have to dig through. It still takes a long time for airlines to get planes. You have, in some instances, engines and spare parts are hard to come by, and then the pilots. So it's a little bit difficult to see the pilot situation normalizing in the next 2, 3, or even 4 years. So you have this bottleneck out there that is going to be hard to solve. I think that layered over, what we see as the good counter-cyclical demand trends at the moment, capacity should be constrained, and capacity remains below 2019 levels on a per capita basis. So that's something that probably takes a very long time to change.
Steve, this was great. Let's do it again. Steve Trent there of Citi on the airlines. Can we get that board back up? Look at these year-to-date gains for the airlines. United, American, Delta, up by more than 45% across the board. TK, the year-to-date gains on the airlines have been absolutely phenomenal. Yeah. Phenomenal.
And what's fascinating to me is Wall Street, like Steve Trent, Helene Beck, and the others, they're focused on these major airlines. I'm really interested in the other airlines we fly all the time that nobody's talking about, including the JetBlue saga. The JetBlue saga.
All that good stuff.
I've never been on Spirit.
You fly so often.
I've never been on Spirit.
Everything that Steve just said that was good for shareholders sounded absolutely terrible for consumers. Did you notice that?
Yeah, I noticed that. But that's Steve Trent. I mean,
he's sitting up in the front row. He's going to be restrained. Oh, yeah, great.
I mean, Steve sits in the front row.
Awesome. Awesome. Coming up shortly, Aaron Cannon of Clear Harbor, Emily Rowland of John Hancock Investments on this market, Vijay Rakesh of Mizuho on Tesla, Barry Bannister of Stifel. Constructive? Not so much anymore. His view changed in the last month. We'll catch up with Barry around the opening bell.
the EU is one of the largest and wealthiest consumer markets in the world. And there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Surveillance, good morning, everyone, on a Thursday. And, of course, Thursday means claims. There's any number of ways of looking at claims. I look at the 4-week moving average. I've got that luxury. But Michael McKee has to really dive into the minutia here of the actual survey data here in 8 seconds and also the revised numbers. I would suggest recently revised numbers have taken on a new importance in weight. 240,000 is the survey. And with our data this morning, which again is slow, and there it is. That's you know, finally it's come out, Michael McKee. What do you see there in claims?
We see good news, at least if you're somebody who wants to see the labor market remain tight. 228,000 is the number. 237,000, the unadjusted number. I'm still waiting for the revisions to drop here. We get a lot of people trying to hit on the DOL website at this time. Continuing claims also up a little bit, 1,754,000 to 1 million and well, here we go, 1,721,000. There's the revision to that number. So that's a little bit better. Philadelphia Fed business outlook, a little changed. Negative 13.5. It was negative 13.7 the prior month. The new orders index, negative 15.9 versus negative 11. Employment is negative 1 versus negative 0.4. And the prices paid index falls to 9.5 from 10.5. So on an inflation basis, some reasonable news out of Philadelphia, but the overall numbers not as good as they could be.
Let's turn to the market here, to say the least. Running green on the screen here. Dow positive, but SPX negative 11 on the Standard & Poor's 500. Yields mark a little bit higher, 7 basis points, 4.84% in the 2-year yield. Michael, I want to get out in front of home sales, 10 a.m. and off to Case-Shiller on July 24. Does the Fed care about the housing market, or is it tangential to the debate?
They care about the housing market because obviously it's very sensitive to interest rates, and of course it has a big spillover effect on the overall economy. But what we've seen is home sales just kind of stop, existing home sales, because nobody wants to trade their mortgage. 90% or 91%, I think, of Americans with mortgages have mortgages under 6, close to 5%, and now you're looking at 7% as a national average. So who wants to do that? Which means everybody piling into new home sales, which we get next week.
Michael McKee with us, and we'll stay with us as we have a conversation with the global head of economic research for Deutsche Bank Securities, with Fed experience that goes into the distant and dark past. Peter Hooper joins us this morning on This American Economy. Wow, the communication of the modern Fed. I used to look at this, in my youth, very fond memories of Arthur Burns and trying to figure out the pipe smoke as it came up. Well, you have seen the Fed from Burnsian smoke analysis to which sandwich Greenspan's having, Larry Myers furious at the lack of communication, to a dot dispersion and all that we see now. Has this communication been fed from Peter Hooper with Burns all the way here to Poe?
You know, there's been a remarkable transition in Fed communication, of course, over the period you're talking about. Used to be that Greenspan was happy if the two newspapers came out with opposing articles about, opposing headlines about what the Fed had just done. Fed tightens, Fed eases. Now, transparency, being as clear as possible, is really the strong push, and I think the Fed's doing a very good job. I think this what we're in the middle of right now is a Fed that has slowed to the pace of a rate hike every other meeting, and it's the off meeting when they're hiking rates, which gives them a chance in the on meeting when they do their new forecast to give us a clear signal which way we might go in the next meeting.
Their optionality forward, given whatever the data is, and if we understand they have to work after the fact, they have to work ex post, do they right now, to Jackson Hole and beyond, do they have good optionality of which way to move?
Very much so. I mean, we have ahead of the, I mean, we're all expecting a rate hike next week, right? That's in the cards. Then the question is, what kind of signal do they give us for September? And then the timing of the next possible rate hike is October-November meeting. We're going to have three more employment reports, 3 more inflation reports. In fact, 2 more of each before they can give us a signal in September about the possibility of moving again in October and November. Their current forecast, their median SEP, says they will go in October, November. We think it'll be September and done because the economy is beginning to move in the right direction, although the claims numbers today don't help us.
Do you ever wish you were Mike McKee in the press conference? Did you ever, like say to yourself, I don't want to be rude like Leisman, but I would really like to be like Mike McKee and get the last question?
Mike has a dream job.
Well, I can't remember exactly how Tom put it when he was introducing you from the deep, dark past or something like that. I mean, I'm there with you. We go back a long way. Have you seen, I can't remember a time when future Fed policy has been as undecipherable as it is now, and this is not the Gang of Four kind of disagreement on the Fed that got rid of Paul Volcker, but there's still a lot of disagreement among members of the Open Market Committee about what should be done next. Does it really make it difficult for people on Wall Street, for investors, to go about their duties when they don't know what the Fed's going to be doing because they told us what they were going to do for so long?
Mike, I've had 2 careers. My first 25 years were at the Fed. My second 25 years have been at Deutsche Bank in the markets. And I have to say, going back to the first 25 years, that this Fed is unusually unanimous in their views. You have no disagreement about the fact that they need to have keep with a tightening bias at this point, because yes, the numbers are starting to go the right way, but we're not out of the woods by a long shot. Okay, labor market's still very tight. Inflation, core inflation, still much higher than they want to see it eventually. So I think yes, you're getting some signals that are more positive, which may be confusing some in the market, and some saying, okay, we're one and done here. Matt Lizzetti, my good colleague and I put out a piece yesterday, actually, on is a recession more likely than a soft landing still, which has been our call. It's now a very close call, and those are circumstances that say, yes, it is going to be confusing. It is going to be difficult to, you're at a critical point. The data need to keep coming in, but the data aren't there yet. So it's a difficult time to be very clear about your intentions.
Let me go back to the claims for a second and ask you this. Is the labor market really tight? Martin Sandbu in the Financial Times, great economics writer, poses that question today because he's looking at average weekly hours. Hours worked are still lower and in almost every category since the pandemic. If the labor market was really tight and people couldn't find workers, wouldn't the current workers be working more? And wouldn't, if the Fed is raising rates, shouldn't we see claims be going up?
You can see some signals here and there that looking a little easier, but wage inflation has peaked. It may be coming down, but it's still 5% plus. It needs to get down to 3% to be consistent with the Fed's target of 2% inflation, given 1% productivity. Yes, the claims numbers, the openings, job openings, the vacancy rate has been coming down, and that's a good sign. But there's still 1.6 openings for every unemployed worker. That's a very tight labor market. You get down to 1-to-1, then you're starting to ease up a bit. We have a long way to go yet.
I've got to change gears here with the worsening situation in Ukraine. The Washington Post reporting a true advent of cluster bombs today. Your David Folkerts Landau was with us, I think, the day of the invasion, maybe the day after. I think we were in London at the time. I can't remember. But the basic idea from Folkerts Landau is at some point there would be massive government investment in Europe. I guess we're not there yet. Recession, there's Germany and manufacturing challenges. What's the Deutsche Bank view of how this war affects the European economy out 12 months, out 24 months?
Our view is that the war is going to persist, will be a background, obviously a foreground factor in terms of on the geopolitical side. On the economic side, our expectation is that the slowing that we've seen from energy price increases has not been as severe as was feared. But at this point, the economy is still pretty hot in terms of labor markets. Inflation is too high, and I think the bigger driving factor is what the ECB does. Our thought is one more and done for the ECB as well, but that's going to be slowing things with the war in the background as a factor.
Right.
Looking beyond the next 12 months, as you say, there's a lot of investment to come along.
But in core Europe, I mean, just the politics of Rutte out in Netherlands, forget about the politics of it. Is the core of Europe have a hawkish tilt that Lagarde and company can't ignore?
Well, listening to Klaus Knott this week turned a little bit more dovish. I mean, saying, look, we may be, it may be one and done. That's a possibility. So the core of Europe is concerned about the inflation picture, certainly, and it wants to see the ECB follow through as needed. But I think the picture in Europe is as in the U.S., you are beginning to see some signs that will be helping us out.
Peter Hooper, thank you so much. With Deutsche Bank this morning, head of all of their economics as well. I look at this, Michael, and it's just, to me, it's a stew. As John and I have mentioned this morning, getting out to September is an easy exercise. Help me with the third week in November. I have no idea where we are.
As Peter was mentioning, there's going to be a lot of data between now and between the 26th, when we get the next Fed decision, and the following decision, the 21st of September. And then you got to go into November. So it's really hard to make a call at this point. If we see the same kind of improvement in inflation that we have seen, but we don't see a change in the labor market, does the Fed, make policy based on what they're worried about or what they actually see?
An inflation adjustment over the last 20 minutes with the economic data, and perhaps Dr. Hooper's comments as well. The 10-year real yield up to new recent highs, 1.56. The 10-year yield out a solid 6 basis points higher, 3.81%. In the equity space, S&P 500 futures down 0.3%. We say good morning, Bloomberg Surveillance on radio, on television. Michael McKee with me as we nudge ourselves towards a Fed meeting. Tell me, please, I'm hoping, are we in quiet period now?
We are in quiet period.
Yes. What do they do in quiet period? Is this when they vacation?
No, they're actually working in the week leading up to the event. That the staffs are putting together the forecasts that they will use internally. They don't publish one this time, but they do a forecast each time, and they're talking to their researchers and looking.
They're learning.
What's going on.
And this is something that Greenspan codified. Peter Hooper mentioned the path back to Burns and Green, and I think of Ed Hyman as well as this. Is the whole Deutsche Bank architecture is data driven. What data do they look at? Like at the Kansas City Fed, I'm assuming they look at data very differently than the San Francisco Fed.
Well, yes and no. They all have their own indicators that they look at, and they all have their own models into which they plug the data that they look at. But they're all kind of focused on the same two things. One is how tight the labor market is and what effect that's having on wages, and what is happening in inflation below the headline numbers that sets us up for the future. Do we still see a lot of sticky prices that are not coming down, particularly in services? Will what we saw last month in CPI continue because base effects go away? That sort of thing. They're trying to model that. And while we didn't get to ask Peter about it, the dollar is going down. Is that going to continue? And what impact is that going to have if the ECB stops raising rates? Do we see the dollar strengthening?
Dollar strength here off the economic data, and euro under a 112 after the sprightly 5, 6, 7 days we've seen for euro 111.79. And please stay with us on radio, on television from New York. This is Bloomberg Surveillance.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
I think is there's probably some scope for resilience still at the high end of the high yield spectrum, specifically because supply has been so low. Over time, I would expect there to be a bit more weakness in that market as we see defaults flow through, as we see risk premium rebuild. Importantly, we don't view a recession as a necessary ingredient for an uptick in defaults.
Selling forward, go to Bloomberg.com, go to all of our digital product on YouTube and search for Amanda Lynham. Spelling's a little different, L-Y-N-A-M. This was a tour de force conversation on commercial real estate. For those of you from sea to shining sea, this may not be a focus. I can tell you in any urban environment with skyscrapers over 20 or 30 stories. This is absolutely front and center. It's ugly out there. Amanda Lynham of BlackRock was just really, really quite good. Red and green on the screen right now. SPX a -12 on futures. NASDAQ down 0.8%, giving us some Netflix and Tesla angst as well. Bloomberg Technology will have full coverage of that this afternoon. The VIX prints a 14 crisis. Out of a 13 handle of 14 shows a true tension in this bear market to come. Bitcoin above 30,000, and John Farrell made me quote that as well. Yield space showing, though, the economic data with 104 is a 210 spread. That's a big number. We've had further inversion here, maybe a little bit of inflation angst out there. Right now, and this is a joy, we are going to stop in the doldrums of July. It's not the killer heat in New York it's been. It's a little bit hot, but we're just going to stop on a lazy Thursday morning with someone with courage to participate in the market. She is Gina Martin Adams, chief equity strategist at Bloomberg Intelligence. You know the maxim, Gina, we both flunked this in the CFA exam. And just to generalize as well, if you miss the 10 best days of a market over 20 years, forever, 30 years, you give up a huge amount of your total return. You gotta be in the market to win. How do people scared stiff by their first share in this market?
Yeah, I mean, I think part of the reason that people have been scared is really just the macroeconomic forecast. Economists for more than a year now have been anticipating a recession that apparently has yet to emerge, at least according to the official dating committee. But one thing that can help investors regain some degree of confidence, I think, is the price trend itself. We noted in a report this week that we've now reached a 76% retracement of the peak to trough decline in the S&P 500. And every single time we've reached such a retracement after a bear market, it has led to future gains in the past. So the technicals themselves can provide a little bit of confidence. I think the technicals sort of breaking out of a range trade this spring really added a bit of fuel to the market's fire this summer. We're starting to see a broadening advance as well. I mean, one of the biggest skepticisms of this market, of course, has been the concentration of gains, where everyone knows the biggest 7 stocks, otherwise known as the Super 7, have driven more than 70% of the gain in the index so far this year. We, over the last 6 weeks, are starting to see a broader market trend develop. Now, 70% of stocks in the whole index are actually trading above their 200-day moving average. So that can help regain confidence as well. But frankly, until we can really get a lot more confidence about the macroeconomic outlook, I think the market's going to have to continue to face these sort of fits and starts of sentiment.
I mean, I take real issue with the sophomoric focus on the 7 stocks, Gina, when I see SPX 12 months trailing up 18%. Yeah. And I get it. We went down big. We've come back big. Define how you define a broadening of a market. Yeah. What tools do you use at Bloomberg Intelligence?
Yeah, so we look at things like I mentioned, the percentage of stocks trading above their 50 and 200-day moving average. We look at just gains over the last month. Look at financials as a good example. Over the last month, financials, and in particular the banks, are some of the leading stocks in the S&P 500. We look at small caps as well. We look at the equal weighted index across the board. When you look at the market X tech and X those top 7, you have seen advances emerge over the last 6 weeks. It's a relatively new trend, and we certainly need to see that sustain itself through earnings season. We're just getting into the thick of earnings, and over the next 2 to 3 weeks, we'll get the bulk of earnings for the non-financial sectors, tech included in that, but also really key are industrials, materials, some of the consumer sectors, which need to start participating in greater degree in the rally. Small caps are a really interesting place right now. Right. We have also never seen this degree of divergence between large caps and small caps in a bull market advance. So if large caps are telling you you're now in a new bull market, according to historical evidence, small caps, however, have only retraced less than 40% of their decline so far. That degree of divergence has never been seen before following a bear market rally. Or a new bull market emerging. So I do think that we want to watch small caps really carefully, look at the profitable enterprises in small caps for signs of broadening, signs of healing, and that would lead to much better economic conditions, which could address that sentiment issue we were talking about before.
You know, I'm looking at Gina, at my theme for Thursday with it's Profitability Thursday, and I take this from Meghnad Desai of the London School of Economics, who said profitability was everything. That's fine, but this isn't grab, dot, and coddle net income. How does Gina Martin Adams define profitability? Is it free cash flow? Is it some special ratio? I don't know.
Yeah, well, we look at it across the board in different ways. I think profitability for financials and real estate utilities companies is defined slightly differently than the rest of the index. But one thing we have been watching really carefully over the course of the last 2 years as evidence of profitability or lack thereof is operating margins. So we really specifically look at operating margins for a core set of companies for the S&P 500. Operating margins do tend to lead trends in the broader indicators such as net income or even, sales growth. So what we do want to see is operating margins continue to heal. Now, the good news here is that excluding the energy sector, which remember is a huge input to the rest of the index, Operating margins did show their first sign of improvement in the first quarter earnings season. We need to see that continue in the reporting of the second quarter over the next several weeks. This is the most important line for us to watch, in my opinion.
Down the income statement, do operating margins improve because of cost cutting?
Yes.
Or do operating margins improve because revenues surprise higher?
Yeah, I think this is an excellent point and something we obviously are watching really carefully as well. So far, it's all about cost cutting, and it will probably continue to be all about cost cutting and reduced inflation pressures that have emerged so far this year. That's typically enough at this stage in the cycle. It's typically enough to see cost cutting and reduced inflation pressures start to ease worries about the earnings stream. But you cannot have revenue decelerate too much to deplete the optimism that is emerging in margins. So the revenue line is definitely something to watch. I think it's too early to expect revenues to start to improve for most of the index beyond the communications sector. If it does, that only adds a massive leg of optimism that really nobody's expecting.
Gina, I don't want to mention an individual stock, but let's take a stock that makes Band-Aids and baby lotion is one example here. And Gina, I'm looking at a 15-16 multiple versus Walmart 24-25 multiple. Are these value traps? Thank you. The control room figured out on radio that it's Johnson & Johnson. Way to nail that, Amy. Value trap to look at these things that haven't moved yet, or is there a real ability to pop?
It's really difficult for me to paint all of it with one big brush. I mean, I think that there are segments of the index, in particular in small caps, where the unprofitability or lack of profits is going to be a persistent drag and is definitely an extreme risk. Within the large cap index, there has been such concentration in the top 7 in terms of optimism that you do see plenty of opportunities beneath that top 7 and even outside of the tech sector specifically, where investors have sort of just ignored anything that's going on. They haven't touched any degree of risk. And so you would expect that there are probably some opportunities there. But would I say it's all value stocks? I can't say that necessarily because there's a lot to be done beneath that headline. And I do think you want to watch things like where are the margin gains starting to surface? Where are companies cutting costs enough to right-size their labor force and their cost structure for a different environment into the second half of this year and into 2024?
Gina Martin Adams, thank you so much. Greatly appreciate it. With Bloomberg Intelligence, a window there into thinking of how to be in the market if you're scared stiff. This guy started out writing code, total nerd fest at Compaq Computer a few years back. John William Gurley is with Benchmark Capital with Emily Chang on the circuit. Look for that. Timely, to say the least.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. 3-day winning streak on the S&P 500. Are we about to snap that? We're negative now by 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the outlook for revenue at Netflix underwhelms. Tesla committed to chasing volume over profit as these cyclicals begin to justify a better tone. We begin with the big issue. Can big winners validate big gains?
Here we are in the midst of the earnings season.
Tech earnings.
We surely do hope that earnings will go up.
We've had this huge boom, that surging 7, accounting for the majority of that outperformance.
It's very expected that we should have a consolidation.
We'd all like to see better balance, certainly in the U.S. market between tech and the rest of the market.
A little bit of broadening in that market leadership. We are currently tactically underweight tech.
Stick with tech.
Take some profit, keep that neutral rating.
I still like my tech stocks, but I think this market is telling me in terms of the performance recently that it is ready to rotate.
Would not be a bad thing at all to move away a little bit from the NASDAQ.
Tech, of course, is where the growth is and is going to continue to be.
Can this AI and really Uber top-led rally continue? I think that's what's really weighing on people's minds.
To discuss, joining us now, Clear Harbour's Aaron Cannon, alongside Emily Rowland of John Hancock Investments. Emily, first to you, is it time to rotate?
Yeah, it's really healthy to see this broadening of market breadth that we've seen as of late. Obviously, some better than expected results out of the financials, signs that there may be a more durable bottom being put in as far as the regional banks go. So we have been warning a potential valuation risk on the mega cap tech side. You know, we like those names, but we've talked a while about diversifying into areas that are actually trading at a discount. Those are harder to find. We're starting to see participation there in the mid cap space and the cyclical part of the market. So I think it makes sense here to see a broader participation.
Aaron, we're seeing it. The rally has broadened. Is it broader for good reason?
I think so. I think that, you know, the prospect of a recession has trended lower over the last several weeks. You look at the surprise index, you look at the general trend of economic data, you look at CPI trending lower from 9% to 3%. You look over, you know, month over month CPI trends at below 2%. You know, I mean, that's the Fed's target. A lot of the heavy lifting the Fed was worried that they may have to do in the back half of the year with significantly more rate hikes just a couple of months ago, looks like it may be off the table, you know, that we could be one and done here, and that with employment remaining strong, the consumer remaining relatively robust, there is an argument to be made that this broadening we've really seen since May 31st, which has been quite remarkable, could in fact signal, you know, more longer-term strength in the market.
Emily, one and done or more to come?
Yeah, I think one and done sounds about right. And there's been some really welcome news for the Fed as of late. Disinflation is everywhere you look. You know, you see it from Aaron mentioned CPI, it's in PPI, it's in used car prices, it's in money supply, it's commodities coming down. The prices paid component in the Philly Fed index this morning provided more evidence that disinflation's in the pipeline. And there are some signs that there's cracks in the labor market. Of course, this morning's initial claims kind of providing evidence on the other side. And pretty interesting, though, to see that the 2-year Treasury yield is up about 10 basis points this morning. That was happening actually before that initial claim print came through. Not exactly sure why. Maybe just a bit of a reversal in some of the weakness that we've seen as of late. But markets are telling you that the Fed might need to get a little bit more aggressive here. I think July is baked in the cake. We'll have to see what happens from there.
Claims look good, 228. The estimate was 240. The right kind of downside surprise. You mentioned the bond market. Yields up 8 basis points at the front end, 485 on a 10-year at the moment, up 7 to about 381. If you take a 3-month time horizon right now, you'll find consensus. Most people believe we're in that sweet spot. You go beyond 3 months, that's when you get some division. Let me give you 2 quotes. Max Kettner, HSBC. We extend our constructive stance on risk assets as fundamentals are still supportive. Here's the but. This support is likely to be sustained until late summer, when inflation begins to rise again. Andrew Honhorst City saying something similar, acknowledging the next few months are likely to look like a soft landing, then saying this: we see upside risk to inflation and downside risk to growth re-emerging in late 23. Emily, that division after August into September and beyond, what are you saying to clients about it?
Yeah, so John, it is the summertime, and what's happening right now is the bears are like melting in the hot summer sun right now. They're vanishing like every single minute, and we're seeing it based on this. Again, it's really a celebration of disinflation that's happening. It has caused the dollar to weaken over the last couple of days, which has really helped spur this risk-on rally. And I think it's right to think about sort of what comes next, because in every cycle, once we see these trends of disinflation, it's actually not great, because it means growth is slowing. And remember how powerful inflation has been for corporate revenues, for pricing power. We just saw the best top line growth that we've seen in a very long time from corporations, especially ones that were able to pass those higher prices along. So as disinflation turns into slower growth, it's going to cause company margins to get compressed. We all know the cost of capital is extremely elevated. As companies defend those margins, the employment rate's going to go up and earnings are going to slow.
Oh, and let's build on that. As Emily pointed out, they told us inflation was good for earnings. Is disinflation bad for earnings?
Well, not necessarily, but I think that there's the other sort of powerful force of just the flow of liquidity. You know, when you look at the COVID period, you had QE, you had fiscal stimulus like we had never seen in our lifetime, and that sort of tide is going out. And I think, you know, to the extent that employment can remain reasonably strong, inflation or disinflationary trends continue, maybe they become a little more bumpy as we approach the sort of 3% and 2% level on headline. You know, that could augur poorly for equity markets. But, you know, we have to think about price too. You look at what the market is anticipating already for 2024 earnings, it's like $246 a share for the S&P 500. That's an 11% growth rate from an already seemingly optimistic 224 full year 2023 estimate number that's right now on Bloomberg consensus. And so that's at over 20 times estimates. That's not cheap. And so I think caution is warranted, even though in the long term, we're big believers that equities outperform most major asset classes.
And just to build on that, when do you expect rate hikes to start to bite? When do we start to see that pain come through a little bit more clearly?
Yeah, that's a great question, Jonathan. I think if you look at the last 16 months ago, we were at 0. As of next week, we'll be up 550 basis points. And the vast majority of that has occurred over the last 11 months. And so I think that's really an important point there, which is, you know, a lot of this tightening, and we know that it occurs, it impacts the economy with a lag, has just occurred over the last 6 to 11 months. And, you know, certainly the Fed's aware of that. I believe the market may be aware of that as well, which is why even though we're not back to the 2% level on year-over-year CPI, the Fed may start to signal more of a neutral posture going forward.
Well, I can tell you, discretionary spending is still holding up in a big way. Check out the airlines. Pre-market. Let's get that on the screen. American Airlines at the moment, just a bit softer, we're down 2%. United up 2%, but do year to date. Year to date, United up 45, American up 46, Delta at 48. We had some earnings from them a little bit earlier this morning. Bloomberg's George Ferguson joins us now for a quick look at them. George, Delta was decent. Has United followed suit? American too?
Sorry. So we just saw, American earnings pass this morning, and so it confirmed what we saw from United and Delta, and that was fare environment is very strong. Though American, you noted, is down a bit, and I think that's because their guidance for the third quarter was lighter than both United and Delta, and was sub mid-single digit sort of operating margins, which is a bit surprising. I think we're trying to figure out whether or not they're sandbagging a little bit, or there's going to be more of an effect from the JetBlue NEA unwind, where American and JetBlue were working together in the Northeast.
George, we're having the conversation this morning as to whether discretionary spending can hold up beyond this quarter into the end of the year and beyond. What kind of guidance are they offering on that?
Well, yeah, so I mean, what we've seen is domestic yields, both for all three airlines, flat to last year. So it's a bit surprising. International, a lot better. So it seems like there might be some, exhaustion on their biggest market, which is domestic. Could mean the consumer's slowing a bit. I mean, we think that generally, 3Q is probably largely baked already because they've probably sold a lot of those tickets. Again, it'll be largely leisure-led. And I think that what we do is we get into 4Q and 1Q, we see if business feathers in, and then next year in spring we'll start to figure out if the consumer is exhausted, if they're going to come back like they did this summer and just fly no matter what the cost.
Or if corporate spending can do some heavy lifting too. George Ferguson, George, thank you. On the latest from the airlines, Delta, United, American, those names performing so well year to date. The question we keep returning to, can discretionary spending hold up? This from Sarah Wolf of Morgan Stanley. Discretionary spending is likely to go down. Delinquency is likely to rise as consumers face the end of a 3-year reprieve. We're talking about student loan repayments. Capital Economics on the same thing. Gone back to this quote a few times from Capital Economics this week. There's always something to worry about. This is what they're worrying about. Excess savings all but eliminated. The impact of higher interest rates and tighter credit conditions gradually starting to feed through. Student loan repayments scheduled to resume. Aaron, how worried should I be about all those things in a second half?
Well, if we're entering even a light recession, employment tends to be the last leg of the stool to drop. And so it's not a leading indicator. And I think that the consumer is obviously critically correlated to that figure. And we'll keep our eyes very keenly focused on employment. But you look at credit card revolving lines, and they've really extended. And where have rates gone on credit cards? Over 20%, right? So that's a challenge right there. If you look at the savings rate, it's dropped to historically very low levels. You look at auto loan delinquencies, they've trended up even though employment's remained strong. And then, of course, as you just suggested, student loan repayments are going to kick back in again. And that's another weight on the consumer, particularly the younger cohort consumer in the U.S. So we haven't seen retail earnings to any great extent. We're going to start to see that next week. But that may shed some light on some of those trends, too.
The futures this morning down about 1/3 of 1% on the S&P. On the NASDAQ, we're down by 0.9%. Ton of earnings out there. Emily, I just wanted to finish on D.R. Horton with you quickly. Home builder here in the United States. It's amazing to me. 12 months ago, 12 months looking out, if you'd said to someone that 5% interest rates of the Fed weren't going to be a problem for the home builders, they'd be part of the success for the home builders, I think we would have been like, what, really? But what it's done, as you know, is suffocated supply in the housing market because no one wants to sell their home. How do you get a read on this economy when you have economists talking up the prospect of recession and we have home builders up 40% year to date?
I know, it's like the recession that's just never going to come. And we just talked about the fact that, the labor market is remaining intact, even though consumer spending is slowing, and this lack of inventory. Mortgage rates at 7%, who that's sitting on a 30-year mortgage is ready to sell their house? I'm certainly not. So, we're seeing some strength in the housing market. We're seeing some strength in other lagging data. But if you look again at the leading economic data, things like weekly manufacturing hours work, the ISM index of new orders, consumer expectations, those are all still flashing By the way, not to mention the yield curve, which 2s10s are at 103 basis points the last time I checked before the show. So all of those things are still telling us the same signal. But here's the thing. They can work with a really long lag. In fact, right now we're at a period between when the leading economic indicators index went negative 11 months ago, and we still haven't seen the recession. Similar pattern that we've seen in other cycles, most notably, hate to use the example, but 06, 07, it was 16 months between the period when the LEI went negative and the recession. So these are periods where you want to stay invested, by the way. You just want to be mindful of overreaching for risk.
Emily, you mentioned the yield curve, negative 102 right now, negative 103, there and thereabouts. Aaron, can I get a comment on that? How meaningful is that? A 2-year at 485 and a 10-year at 382. What does that even mean?
Yeah, no, it's a real sort of conundrum in some sense, because the equity market's sending one signal and the bond market, not only the inverted yield curve, and it's been inverted for a long while, which tends to give even more credence to its signal that a recession is around the corner, if not the back half of the year, the first half of next year, which wouldn't surprise us here at Clear Harbor. You know, we are of the view that that there are some weights on the market. We need to be very sensitive to those weights going forward. But certainly we do see value in certain components of the fixed income market, particularly if you think the Fed is 1 or 2 and done. You look at long-term inflation expectations, the 10-year break-evens are at 2.25, and you can own T-bills at over 5%, and even the 10-year rate well above that rate. Historically, those are not bad times to dip in the market.
Aaron Cannon, Emily Rowland, to the two of you, thank you. Just breaking down a price action and a ton of earnings going into the opening bell, about 15 minutes away. We are at session lows on the S&P 500, down about 0.4%. On the NASDAQ 100, down by almost 1 full percentage point, negative by 0.93%. Let's get our teeth into some of those earnings reports out there. We can do that with Abby. Morning, Abby.
Good morning, John. And yeah, it feels interesting today to have the futures down so solidly, not something that we've seen very often in this melt-up. And it has everything to do with these earnings you're talking about, especially Netflix and Tesla. Starting off with the shares of Netflix, heading to the worst day of the year potentially on a revenue miss and a weaker guide. Despite the new subscription blowout, the stock, of course, up more than 60% year-to-date into this quarter. Investors wanted perfection. They didn't get it. Something similar for Tesla, but this stock actually up 136% on the year into the quarter. A margin miss not tolerated. Plus, CEO Elon Musk, well, he's saying if rates keep rising, they're going to have to keep lowering prices. An example of the pain of rates rising in real life. And then finally, Key Corp, we still have some of these regional banks reporting their second quarter total deposits of about $143 billion, basically met, but they had to pay up more, that interest expense rising, so the shares down sharply.
Abby, thank you. Stocks are down. The bond market's down too. Yields are higher by 8 basis points on a 2-year. Jobless claims in America, actually decent news. Downside surprise. I always say the right kind of downside surprise on jobless claims. 228,000. The estimate was 240. The previous read was 237. Coming up next on this program, President Biden ramping up his messaging on the U.S. economy.
I don't think the problem in America today is too many people working or working people are making too much money. Instead, we focus on getting Americans into the workforce by fixing a broken supply chains and lowering costs.
The latest in Washington, up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Bidenomics is about increasing competition, not stifling competition. When companies have to compete, it means lower prices, fair wages, and more innovation. The Department of Agriculture and partners in the states are going to make large corporations making sure they cannot artificially raise food prices through price fixing and price gouging. We're cracking down on hidden junk fees in rental housing.
President Biden announcing new actions to aid U.S. consumers. The latest efforts coming as polls show the president underwater when it comes to key parts of the economy. That includes the labor market, even with jobless claims near historic lows and unemployment around 3.5%. Bloomberg's Anne-Marie joins us now from Washington, D.C., alongside Mike McKee here in New York. And Mike McKee, the latest data, pretty decent.
Well, you got to go back to the Bill Clinton campaign in 1992. James Carville, his campaign manager, said it best. It's the economy, stupid, and every year it turns out to be the major issue. And if that's the case, well, I'm reminded of Ronald Reagan running for re-election in 1984 after 2 recessions left the economy sort of reeling. Look at jobless claims. Those are Reagan's last three for this period of time in his 1983 position, and then these are the Joe Biden numbers for 2023. Biden in much better shape. But their polling results, as you mentioned, are just about the same for this period in their incumbencies. You can see Biden basically running right alongside where Reagan was, and that was not good for Ronald Reagan, but we all remember what happened after that. You get to 1984, and Reagan swept the election, winning every state except Minnesota. The difference was that the economy by that time had put the bad news behind it, and it was morning again in America. And so Joe Biden has to hope that jobless claims are a harbinger of that as we see inflation go down and unemployment stay low.
AMH, we've asked this question a lot, why that data isn't translating into better polling.
Well, it's really how people feel. We spoke to Amy Walter yesterday for the Cook Political Report, and she said even if the data is starting to show inflation is quelling, this has been top of mind of American voters. The issue is maybe Americans just aren't feeling it yet. Things are still costing more. Jonathan, only 3 in 10 Americans, they say the country is doing better than the rest of the world when it comes to the economy coming out of the pandemic. And when you look at a recent AP poll, when you look at Biden's handling of the economy, that was about some 34%. That was lower than his overall approval rating, but is why you see this administration really try to own Bidenomics. This term that when I first saw it was from an opinion piece in the Wall Street Journal that said the president really had little knowledge of the private sector economy. It was quite critical of him. They are trying to now own this narrative and talk about the legislative agendas, packages that they were able to get through when it comes to fixing roads, fixing bridges, expanding broadband, diffusing the debt ceiling. The problem is, Jonathan, will it land for voters in November of 2024?
Well, AMA strategy, tactics, let's build on that a little bit more. We look at that data, Mike McKee's gone through it, jobless claims, historic lows, unemployment incredibly low, 3.5%, and then the administration focuses on junk fees I've never heard of. Have you ever heard of some of these junk fees?
Well, I think the issue is why they're probably focusing on things like junk fees is because this probably polls well with Americans. Americans don't like the idea that they're have these extra fees when they're focusing on buying, using in their credit card or whatever it may be. The administration seems to be, or Biden seems to be quite obsessed with that. So I imagine that's showing up in the polling data as a good point instead of going out with these hard numbers. Remember, Biden likes to talk in very plain terms to the electorate. We saw that this week. He was talking about consumers when he convened his competition council, and then he's going to be doing the same today. He's going to Philly Shipyard in Philadelphia, and he's going to talk about Bidenomics, building from the middle class out. But I spoke to the Treasury Secretary this week, and she was pretty clear. She says that the U.S., she thinks, could avoid a recession.
AMH, thank you. On the latest, Anne-Marie down in Washington alongside Mike McKee on the latest economic data and on the latest polling too. Coming up, the morning calls, and later, the latest earnings. Netflix, Tesla, kicking off earnings season for big tech. That conversation's still ahead with Mizuho's Vijay Rakesh and Stifel's Barry Bannister.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Minutes away from the opening bell. Nasdaq underperformance here, down 0.8%. The S&P negative by about a third. That's the price action. Here are some morning calls. Deutsche Bank downgrading Avis to hold, expecting a volatile Q2 earnings season after the stock's notable gains this year. JP Morgan raising its Netflix price target to $505, recommending investors buy the dip with a longer-term outlook remaining solid. And finally, Piper Sandler raising its Tesla price target to $300, saying nothing from the conference call questioned the broker's bullish thesis. We're negative there, about 4%. Coming up, more on Tesla's latest results with Mizuho's Vijay Rakesh, plus Stifel's Barry Bannister calling time out on the equity market rally. Your opening bell, just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup.
This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Three-day winning streak on the S&P 500, about 20 seconds away from the opening bell. Equity futures just a little bit softer, negative by 0.3%. Tons of earnings out there, disappointments for the likes of Tesla, Netflix. We'll get into that in a moment. The Nasdaq is negative about 0.8%. There's the opening bell. Switch on the board and get to the bond market. Earlier this morning, about an hour ago, jobless claims, the right kind of downside surprise. Yields up 6 basis points. A week yesterday for a Fed decision, looking for another hike in July and looking for guidance on what they might do beyond that in September. Your 10-year, 380, 90. Your 2-year, up 7 basis points to 484. In the FX market, just a touch of dollar strength. We break 112 on the euro, a week away from an ECB decision. 111.86 with negative 0.1% there. And crude, just a break of 76, almost up 0.8%, up 60 cents on the session on WTI. We're about 30 seconds into this, we're negative 0.2% on the S&P, a whole lot more negative on the Nasdaq. The one stock to watch at the open is Netflix, under pressure after projecting a weaker than expected outlook. The company writing to shareholders, we have more work to do to re-accelerate our growth. Abby has more. Hey, Abby.
Hey, John. And what makes that interesting is that case could be true ahead of the quarter, because going into the quarter, you had the company looking at revenue growth for this year of mid-single digits. Right now, 7.1% revenue growth on the year. The stock up 60%. That's why you have this stock heading to its worst day of the year. It was priced for perfection. Investors simply did not get it. Now, what was interesting, because of the password crackdown, subscribers really surged, but it didn't equal big revenue. There was a little bit of a revenue miss, and the revenue guide is disappointing. So that's what investors are really weighing in on the stock. Now, Morgan Stanley does expect Netflix to deliver on its year-end target to re-accelerate that revenue growth by double digits for the fourth quarter. So that's pretty aggressive. They do have their work cut out for them. They will have to translate some of those ad subscribers to fully paid subscribers. One point of agreement on the street is exactly that, in fact, that the password crackdown has not equaled that yet. One positive, though, John, is the profitability for this company. They did put up 22% margins. They also posted $5 billion in free cash flow. So it's not all negative, but investors right now, with this stock down 6.4%, really focused on the fact that they want the revenue to come from the password crackdown.
Abby, thank you. More on this story a little bit later. Mandeep Singh joining us on the program. Let's turn to Tesla. The automaker warning of more hits to its shrinking profitability. Elon Musk downplaying margin concerns and saying this: it makes sense to sacrifice margins in favor of making more vehicles because we think in the not too distant future they will have a dramatic valuation increase. David Wells joins us now for more. David, the stock is down by 4%. Can you explain what Elon Musk meant by that?
Well,
I think if you look at the vehicle market, it's relatively strong. There's still not a lot of inventory out there, so people are still looking for cars. Maybe he's just generally looking at the strength of the consumer and that people will be buying vehicles and that they're not going to have to do as much discounting. But it was honestly pretty vague. I don't think investors are really buying it, obviously, because the shares are down. And I think in the case here, there's sort of a sin of omission. The one thing that Tesla didn't say, which they've often said, is that they want to maintain industry best margins. Because the amount of margin slippage in the quarter wasn't bad. These were overall pretty good numbers. But investors are looking ahead, and Tesla's not committing to that the way they typically have. And I think investors are just saying, okay, if they're not committed to industry best margins, then profits are going to be under pressure going forward. And Elon's not really explaining how he's going to boost the value of these vehicles. Part of it is some of the software and things they want to put in these cars, but it's not really explained. Near-term investors are kind of thinking they'll put their money someplace else and wait to see how all of this shakes out.
Explains the weakness this morning. We're down 4%. You have to think about that relative to the gain so far year to date, though. Before that move, we were up by something like 135%. David, thank you. David Welsh there on the latest. From autos to airlines, American Airlines reporting quarterly profits in line with expectations. The more modest outlook coming after a strong report from United. Isabel Lee has more. Hey, Isabel.
Hi, John. It's vacation season, so maybe this is timely. But yes, American Airlines shares are falling, down about 4%, after quarterly profits were just in line with Wall Street's expectations. Adjusted earnings will be 85 to 95 cents in the next quarter. That's smack in line with that's actually above the 90-cent estimate. So it was a modest outlook that offered investors a reality check. And this came after United Airlines and Delta really offered strong reports. United came in with strong third quarter and full year earnings estimates. The company said it will earn more this quarter thanks to a travel rebound. Year to date, though, American, Delta, and airlines are seeing gains north of 40%. And overall, we're seeing a global recovery as travel rebounds. So people are expecting it to surpass 2019 levels. So we'll see how that plays out.
Massive gains year to date on those names. Isabel, thank you. We talk about big tech all the time, the dominance of these magnificent 7 stocks. Need to talk more about airlines. And for me, the story of the year, right here, the home builders in America. D.R. Horton topping earnings estimates thanks to a tight housing market. The company's saying, quote, despite higher mortgage rates and inflationary pressures, our net sales orders increased as the supply of new and existing homes at affordable prices remains limited. Katie, I wouldn't say despite, I'd say because of mortgage rates. This is what they're doing.
This is what they're doing, and it was a beat and raise quarter for several factors when it comes to D.R. Horton. Of course, like you said, mortgage rates. We know that D.R. Horton has been using mortgage rate buy downs to make those houses more affordable. They said that doing that really cuts rates by about 1%. And also that shortage of U.S. existing homes has been a big boon for D.R. Horton. They said that fueled a 37% jump in purchase contracts to nearly 23,000. That is well above analyst estimates. And to tie it all together, D.R. Horton actually reported fewer deal cancellations in this quarter at 18%. That number was 24% a year earlier. You take a look at the shares, though, and it's pretty interesting. Right now, we're about flat. We actually dipped negative as the bell rang. We had been up as much as 8% in the pre-market. We are getting the call right now, getting some comments from executives. They did say that significant increases to mortgage rates would hurt margins. So maybe you're seeing some of that caution in the shares right now. I will note, though, that D.R. Horton is about $2 away from an all-time high. But even at these nearly record high levels, D.R. Horton has been underperforming the industry overall. The S&P index of home builders up nearly 56% this year. D.R. Horton currently about 48% higher in 2023.
What a run. Katie, thank you. No doubt Katie covering that a little bit later on this afternoon. Let's turn back to Tesla. Stocks lower by almost 4%. The automaker beating second quarter expectations, but the company warning about more hits to profit. Mizuho's Vijay Rakesh saying this: with a weaker consumer and higher rates, Tesla has been leveraging price to drive volume at the expense of profitability. While margins could remain a key concern for investors near term, we could see second half tailwinds from commodity and logistics cost declines. Vijay joins us right now. Vijay, just build on that if you can. What do you see going in their favor in the second half?
Yeah, thanks for having me on. I think as you look at the second half, obviously Q3, they did say there'd be a small slowdown in the production side, but we think that could be made up by the inventory that they have on hand. But going into the second half, obviously, if some of the cost declines on the logistics and the raw material side start to hold, that could continue to help them on the gross margin line. One key highlight I would say on the June quarter was despite almost 200 or 900 bips of pricing cost cuts or price cuts on their Model 3, Y, and S, etc., the gross margins for Tesla were down only 100 bips. That shows massive cost efficiencies that they're leveraging across your supply chain. So
that's been an area of huge improvement for them across the last several years, you could argue. Vijay, you mentioned inventory. Global inventory, a lot of people pointing out it's up to 16 days. Now, Vijay, I'm not deep in the weeds in the auto market like you are. Can you tell me how significant that is?
I think that you have to differentiate a little bit between, let's say, Tesla's own inventory at like 50,000 units, which is, is pretty small, versus the global auto inventory, which is definitely going up. I think that's more a function of some of the consumer taste moving from combustion engine to electric vehicles, but also, as you mentioned previously, high rates. It definitely becomes a drag on the consumer to having to pay these high loan rates while buying the vehicle. So that's definitely going to be a drag, we think, on the second half on the broader automotive market. But for EVs in specific, you have a lot of subsidies that are flowing through the system. At the same time, you have OEMs like Tesla trying a little bit more flexible with pricing to the consumer. So that should help.
Tons of subsidies, yet, Vijay, at the same time, Ford cutting prices, inventory climbing at the likes of Tesla. There might be some people watching this, listening to it, Vijay, saying that maybe actually we've tested some of the limits of demand out there at the moment for some of these vehicles. What would you say back to that?
Yeah, I think there is still room to grow. I think if you look at the pricing on these Model 3 and Ys, they definitely come down, but it's putting a lot of pressure on the ecosystem. That's why you're seeing Ford, etc., which you do not cover, but seeing their inventory spiking up, they're cutting pricing. But let's not forget, if you look at Tesla, they're running 10% operating margins on a $100 billion annualized business, and that compares to many of the startup and legacy OEMs that are running electric vehicles at 30% negative operating margins. So there's a massive moat between what Tesla is running at scale versus you can characterize some of the other EV OEMs still at subscale, still ramping up. But that's a huge I would say a positive for Tesla. So
Vijay, thank you, buddy, for catching up with us on a busy morning for you. I know you've got a lot of calls to make, so thank you, sir. Vijay Rakesh there on Tesla. Tesla negative this morning by around about 4%. On the S&P 500, we're down about 0.1%. Stifel's Barry Bannister shifting his focus from big tech towards cyclicals, writing this: we continue to see the S&P 500 level at around 4,400 for the remainder of 2023, with cyclical value outperforming cyclical growth. This occurs as a result of rising real yields, pressuring PE valuations, and because 23 is conforming to our view of a slowdown without a recession. Barry Bannister joins us now for more. Barry, I'll say up front, you were constructive and right for 2023. Let's take it to the next place you want to go from here. Do you think the market cap weighted S&P 500 from here then is going to be challenged? And if so, can you give us the why?
Yeah, I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500. Since mid-year, we've been saying that one of the trades you could do was long equal-weighted, short cap-weighted S&P for a broadening of the market. The other, as you mentioned, is the cyclical value, and that's really banks, diversified financial services, industrials, basic materials, and some of the transports.
Barry, do you think that's a short-term tactical play through the summer? Heard a lot of people say there's a sweet spot here for disinflationary trends, or do you see it being somewhat more sustainable than that?
Well, policy works with a lag, and recessions tend to come as surprises. I do think the employment markets will weaken towards year-end. You've got corporate pricing power with a weak PPI, weakening inflation. You've got corporate pricing power falling below wage growth, and wage growth being fairly high is keeping the core PCE ex housing, which is called super core inflation, above what the Fed's comfortable with. So if the Fed is not willing to accept that the normal run rate for inflation going forward with positive goods prices and strong services demand is going to be closer to 3% at the core level, and they're still talking 2%, then they're going to stay tighter for longer, and eventually that'll weigh on the market into 2024.
Do you think, Barry, that's a September time story? That until then we're in this nice spot and equities can do nicely?
Well, we've both been doing this long enough to know that September, October are treacherous months for the market. So if there's going to be any pullback towards this 4,400, it would probably be at the end of the summer and into the early fall. And as we conclude the year, though, we do think employment markets will weaken. And once they weaken just a little bit, it won't take much. It would be a pre-recessionary signal. We would know that at some point in 24, a recession, however mild, was coming. And one thing I would throw out there, Jonathan, is I'm pretty bullish on oil prices from the supply constriction side. I actually think we're going to have a mini oil shock in 2024. And when that happens, on top of unemployment, you could see a lot of tumult on the interpretations from Washington of what's going on.
Barry, just out of interest, are you positioned for that now? How would you suggest someone positions for that out on the horizon out in 2024?
No, I mean, everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year, it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You know, you really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. We are not in a buy and hold 10-year-long double-digit bull market anymore. We have to be very tactical in how we trade this thing.
Well, let's focus on a tactical trade then, Barry. Just a final question from me. What are you telling clients? Do you do this through a single name, through a sector, through an equal weight index on the S&P? What are you suggesting?
You know, like I said, it's heresy for a broker to say this, but there are ETFs to trade everything. And so if you were long RSP, the equal weighted S&P, and short SPY, that's the long equal weight, short cap weighted. The other is if you buy the KBW Bank Index. KBW is a subsidiary of Stifel, KBE on the ETF. You can participate this in multiple ways. There are sector spiders and industry spiders at BlackRock that are perfectly good for trading just the names of industries that we just listed.
Barry, appreciate your time today. And again, great call so far year to date. It's interesting to see you make a change in the last month or so. Barry Bannister there of Stifel on the equity market, just making a tactical call for this market to broaden out away from the dominance of big cap tech, but ultimately putting a time limit on it and then raising a flag potentially on a risk around energy for next year. Fascinating stuff. 15 minutes in, we are just a little softer by 0.1% on the S&P. On the NASDAQ, that's where your underperformance is this morning. And this is where it is at a single name level too. Coming up, Netflix delivering a disappointing outlook.
Listen, Netflix is winning the streaming wars. There'll be some consolidation. Pricing will be raised by the others, and marketing costs will come down, and they'll eventually turn profitable. But Netflix clearly has the lead and will be the long-term winner.
That conversation up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive
positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Netflix CFO Spencer Newman weighing in on the earnings call. The stock heading for its biggest drop of the year after delivering a disappointing outlook. The company writes in this: while we've made steady progress this year, we have more work to do to re-accelerate our growth. Geetha Raghunathan of Bloomberg Intelligence joins us right now. Geetha, this is the $195 billion question this morning. How do you beat subs by as much as they did and then come in light on revenue? What happened?
Yeah, that's really puzzling. So, I think what happened was obviously their paid sharing crackdown, or their password crackdown, kind of went into effect. It looks like that was obviously a success because, you did have that big, it did spark that increase in subscribers. I think what has happened, though, over the past few months is Netflix has actually cut prices in many international markets in order to kind of reinvigorate that subscriber growth. I think that's what we saw kind of flowing into the ARPU a little bit, as well as I think what happened is Netflix was probably hoping that with that password crackdown, they would kind of really get it to be a catalyst for people signing on the cheaper ad plans. And remember, again, the ad plan, you're paying only about $7, $8 for subscription, but you're making up the rest through advertising, which kind of makes it equivalent to a standard plan with $15.50 in the US. I think what happened instead were maybe people started to sign up for the ad-free plan, which came in at about $10. And I think yesterday's move by Netflix to actually eliminate that plan, both in the US and UK, shows that they do want to kind of drive ARPU higher. So I think there's, different moving pieces here, lots to parse out. But I think maybe the revenue impact that they were hoping for obviously is going to flow in a little bit later than they had initially anticipated.
Geetha, do you think that's something you can achieve in one quarter? Does it take several quarters? How long do you think it would take for that to be successful?
So I think investors were definitely expecting. So Netflix itself has outlined this revenue target or reacceleration of revenue growth in the double-digit territory. Obviously, that's not happening in the third quarter since they guided to about 7.5% growth. However, I do think that, with all of the different initiatives in place, and as those effects of, password crackdown and the advertising-based plans kind of start to flow through, it will happen in the fourth quarter. So we actually think that, Netflix gets to that 10% growth in 4Q, and then we're definitely going to see a much bigger ramp up, I think, in revenue in 2024.
Just one final one, Geetha. I know you're super pressed this morning, but just on the strikes in Hollywood, did they flag that as a concern on the call at all?
They started the call with the strikes, and they said that they're really looking to kind of achieve an amicable solution as quickly as possible. They didn't want the strike. They wanted to get resolved as quickly as possible. But having said that, they are really not in as bad of a situation, even with the strikes going on. In fact, it's actually going to boost their free cash flow. They boosted their guidance for free cash flow by about 40%. So yes, if it drags on, it will be a problem. But right now, no immediate financial impact.
Hear that from a lot of analysts, particularly relative to the competition. Geetha Raghunathan there of Bloomberg Intelligence. About 22 minutes in to the session, we're down 8% on that name. We're down about 0.1% on the S&P. Let's get you some sector price action. Here's Abby.
Based on that small loss, John, this is not intuitive, but most S&P 500 sectors are higher. But what we are looking at is that consumer discretionary dragged down by Netflix, down 1.4%. We also have communication services and tech down. So that's really the heavyweights dragging on the index, whereas energy, healthcare, utilities, financials, staples, and industrials higher. As for the real estate sector, earlier you were talking with Katie about D.H. Horton. We have the real estate sector on the day, or over the last few days, down 1.8%. It's interesting because DHI all over the map, and SL Green, an office property owner here in New York, the biggest one, John, well, they reported disappointing outlook in terms of, or I should say, they lower rents for the quarter that just was. That stock down, John.
Abby, thanks for the latest. That's some of the soft spots right now in the equity market. Your trading diary. Up next, the runway into the weekend.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Snapping a three-day winning streak on the S&P 500. About 26 minutes into the session, we are negative by 0.07% on the Nasdaq. Your underperformance, we're down by about 0.5. That's the price action. Here's the trading diary. Existing home sales at the top of the hour. You'll hear from the president again at 1 p.m. Eastern on the economy. The Nasdaq's rebalancing happening over the next week, into next week. Tech earnings ramping up Tuesday with Alphabet, Microsoft, and Snap. And finally, Fed rate decision. That's next Wednesday with the Chairman Powell News Conference. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Too many.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Gina Martin-Adams. She's a chief U.S. equity strategist with Bloomberg Intelligence. She's got a new note out calling it the new S&P bull market. So we'll get a sense of her outlook here as we plow into earnings. Plus, Ann Hines, she's an analyst at Mizuho Americas. She's a managing director there. Covers all the healthcare services companies. We're going to get her preview of what to look for in some of these earnings coming up from the healthcare companies. And then we're going to talk to Jonathan Maxwell, CEO of Sustainable Development Capital. He's going to join us to discuss the outlook for oil and the renewable energy market, all that's coming up. But first, let's kick it all off with a Bloomberg Business Flash with John Tucker.
All right, let's start with the data. You may hate your house, but you love your mortgage, that low mortgage, so you're not selling. Existing home sales, I call them used home sales, coming in at an annual rate of 4.16 million, so that's lighter than the previous month. On a month-to-month basis, percentage-wise, that's down 3.3% existing home sales. And then you have the index of leading economic indicators that is down a negative 0.7%. So that was worse than was expected there. Investor sentiment weighing down by lackluster quarterly earnings from Netflix and Tesla. You know the results there. Most economists, meantime, surveyed by Bloomberg, are expecting the Federal Reserve to lift interest rates one more time next week. Then they think they're done. Sam Zeif at JP Morgan says the Fed and central banks worldwide, they have been effective in bringing down prices.
This kind of wave of disinflation that clearly started in the U.S., it's showing up now in Europe. Inflation has clearly peaked. Inflation, like goods disinflation, has started. Energy deflation has actually started.
And right now the S&P 500 5 points lower. That's down 0.1%. 4560 on the index. The Dow Jones Industrial Average up 221 points, a rise of 0.6%. NASDAQ 100 right now, as you might expect, down 108 points. That is down 0.7%. Tesla and Netflix doing some of the damage there. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. I'm at your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. Appreciate that. Looking at the Dow Jones Industrials up 219 points. That's kind of bucking the trend. The S&P and the NASDAQ are off a little bit there. Let's check in with Bailey Lipschultz. First of all, Jess Metton, thank you for joining us on Friday.
Almost Friday?
Almost Friday. It's Friday for me.
We're almost there.
It's Friday for me because I'm off tomorrow.
Another day at the shore, the Sweeney compound.
Another day at the shore. That's how you do it in the summer in Jersey. It's Jess Metton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming live on YouTube, so you can head over there and just search Bloomberg Global News, and that'll pick up the feed for you for Bloomberg Markets. Bailey Lipschultz, he's a markets correspondent here, joins us in our Bloomberg Interactive Broker Studio. Bailey, what are you looking at today?
Yeah, everything, all tech so far this morning. So everyone obviously kind of pounding the table on Tesla and Netflix after their results. But when you're looking at another kind of range of movers that we're keeping an eye on so far this morning, it's hard to overlook a stock like Discovery Financial's ticker DFS. Right now, down more than 14% after compliance issues forced the company to pause its buybacks, had underwhelming quarterly results. So negative news out from that company, which is a credit card firm. Another couple stocks that I'm keeping an eye on, United Airlines trading higher after strong results, beating expectations really on foreign travel. Another company, Catalent Inc., which is a company that really essentially helps biotech companies develop drugs and study those drugs, up about 3% this morning after Elliott took a stake, announced a stake, and will be pushing for board changes. That stock down more than 50% in the past year, though, so pretty ugly move, broadly speaking, for that stock, but moving a bit higher in what, again, is a day that all we do is really talk about big tech earnings.
And you cover the retail investor space so closely, so I have to ask you about the latest AAII survey. So in that, about more than actually 50% of investors in the latest survey that came out this morning said they were bullish on equities for the first time in 2 years. And if you look over the past 7 weeks, seeing that turn higher, and that's the longest streak there since about the spring or mid-2021. So what is this telling us? And at what point do you think it could get maybe potentially too excessive? Because I mean, it was so bearish for so long, especially when you're looking at this chart. It makes me wonder, maybe this has legs and can continue on there.
Yeah, and that's what we're seeing from reaction from JP Morgan's Peng Cheng. From their research, looking at their data, they actually think retail positioning does not appear to be stretched. So this is really a catch-up trade for the retail crowd that had maybe been sitting it out for the last few months, really. And Jess, I know we talk about this all the time. Are they a leading indicator? Are they a lagging indicator?
Right.
And when you look at the charts, obviously Magnificent Seven is drawing them into some of those big tech stocks, but it does seem like retail has quite a bit of cash to deploy, and that's something that's obviously worth keeping an eye on as earnings season continues to accelerate, even though we are in what are typically the sleepier months for retail traders.
So what do the flows look like in the positioning on the retail side ahead of a lot of those big tech and growth names that are reporting soon? Like we have Meta next week, also Microsoft the week after that. We have Apple as well. What does it look like?
If retail is still putting their money into the stocks before and after these results. When you look at Tesla, we saw them being, again, not a shocker, the most purchased single stock on the Vonda platform. So you're seeing retail continuing to pile into the Teslas, the NVIDIAs, the Apples, as well as the broader benchmarked ETFs like the Qs and the SPY. So retail is really sticking to those bullish guns and calls with some of these big tech companies that they prefer. And obviously, when you see a reaction like we saw with Discover Financial this morning, I'm going to be interested in seeing if retail buys the dip, just because 15% drop for a credit card company, even with all those compliance concerns from retail perspective, is probably looking at the long game and willing to put some money to work.
Our good friends at Netflix having a tough day out there. The stock off about 8%, but you know it was up only about 50% year to date. But I mean, I guess the challenge there is, you know, where's the revenue growth going to come from now that the subscriber growth has kind of plateaued in most of the major markets around the world? So I guess it's ad tier. It's going to be cracking down on the file shares, but I guess the street might have been a little ahead of kind of where the company is.
Yeah, I think that's really just been the case, is that this is a stock that, as you mentioned, has been on an absolute tear. This time last year was trading for about $213. Even with the drop, is still north of 435. So more than doubling over a 12-month period, as you mentioned. It really is the focus on how can they drive growth, how can they beat or meet expectations, and this is the opposite, in my view, of what we've been seeing with banks, where they were talking down earnings going into it and then beating those expectations. Wall Street kind of really rushed and was playing leapfrog, trying to raise those expectations for the year. And when you're looking at, as you mentioned, crackdown on password sharing, the ad tiers, not quite hitting what Wall Street was looking for, but on the grand scheme of things, pretty strong.
Are either of you two password sharers?
No.
Oh, I don't pay for anything.
Would you like to be?
I pay for Apple Music. Otherwise I'm like flying on my brother, my dad, my future in-laws. I only share passwords.
Even at Netflix, because a lot of analysts were saying that's a real area for upside. If they can actually do it, that it can be a big source of upside. And I think all Netflix is saying, it's going to take, we're not going to do it all at once. It's going to take time over a couple of quarters.
Yeah, and it's interesting because it is kind of copying or mirroring that Hulu model. I know I have friends who pay for Hulu and they buy the lower tier, which has advertising, and they're cool with that. I luckily, again, am being shared password, so I don't have ads. But
they're possibly listening. How do you spell your last name?
No, exactly. It's not in my name, which is the positive, so they can go ahead and try to crack down my accounts. I don't have one.
But I guess you get it comes up on your screen like if you're, for the people that are kind of cheating, they just come and say, hey, you can either start paying or, you can pay this up fee to stay on your parents' account or
because
something
I pay for Netflix, but there's other accounts that I use from other family members for streaming.
Yeah, I think there's some swingy offspring
that are
they got some very rude awakening over the past couple months from Netflix. So, and I just told them I got nothing to do with it. This is the big brother coming down on you. All right, Bailey, thanks so much for joining us there. Bailey Lipschultz, that's his last name for anybody listening. Any of the authorities. All right, let's check in with Gina Martin Adams because we just got through and we're getting through a week of big time earnings here. Gina Martin Adams joins us. She's the chief strategist for calling all the markets, equity markets for Bloomberg Intelligence. Gina, again, another great first half of the year, a good July here for these markets. We're getting into earnings. As you step back a little bit, how do you think about these markets here?
Yeah, I think the markets have largely followed along with earnings trends, believe it or not, because when you exclude the energy sector from the S&P 500, it's important to keep in mind that energy is an input cost for most of the rest of the sectors. So we want to exclude the energy sector. And what we find is earnings trends are actually improving pretty materially for the rest of the groups in the index, at least relative to where they were last year. And that improvement has been pretty continuous throughout 2023. At the very least, earnings are much less bad than anyone had anticipated for the groups that are outside of energy. And that seems to be powering a pretty significant market advance.
And is that why, to your point, powering this advance that we've seen, were investors already looking ahead and seeing that improvement, especially when you were talking about energy masking those improvements? I know that when you're looking at the earnings revision momentum data on your team, Michael Casper was talking to me about how, particularly when you're looking at discretionary and industrials, those were the two key groups that were leading those growth downturns at the beginning of last year. But now those are starting to be marked up higher. So more of those cyclically oriented corners of the market did investors already foresee that? And that's why we, in part, saw that big rebound at the beginning of this year.
Yeah, I think what happened was by the end of last year, investors were largely pricing a pretty significant recession in earnings to continue throughout 2023. So remember, ex-energy, we did see earnings start to crash really throughout 2022. By the end of last year, really all hope for any kind of rebound was gone. And investors were only anticipating that earnings would get worse. But what we've seen so far this year is the turn in inflation has been very, very consequential for turning around the sentiment towards select industries and most of the ex-energy industries in the S&P 500. Last year, remember, when inflation was accelerating very rapidly, and producer prices in particular were accelerating extremely quickly relative to consumer prices, most U.S. companies were experiencing some degree of inflation distress. At the same time, it was very clear that tech and tech-like industries were overhired, had too many employees relative to the pace of sales growth that they were experiencing, and needed to right-size the ships. So we saw that occurred late last year. Early this year, we started to see inflation pressures ease. And the combination of those two things has resulted in much better performance across the space. Some of the segments that, as you point out, are very sensitive to inflation, like some of the consumer discretionaries, consumer staples, industrials, communications, even healthcare companies, have experienced a great degree of inflation reprieve. The result of that is likely to show up in better earnings growth into later this year and into 2024. And I think that is starting to get embedded in prices. I would not say that this has been anticipated. I think that most investors are still quite skeptical with respect to the macro outlook. Most investors are looking at top line growth and very concerned about where the economy is headed. But what's happening beneath the top line is very, very important and consequential to earnings trends. And I think that's been the lesson of 2023.
Hey, Gina, I'm just looking at the S&P 500, and off of the October low, we're up almost 28%.
Yeah.
Is that a bull market that I just haven't been talking about?
Yeah, it's a great point. We actually did some work on this week. That gain from the October low to date retraces more than 76% of the peak to trough decline. When we look back in history and we look at all bear markets, that is all times the S&P 500 has dropped at least 20%. We look at those points in time in which the S&P started to recover, and a 76% retracement of the peak to trough decline after every single bear market since history, in U.S. history since 1929, suggests that critical level never gets broken again, right? What we actually find is over the next year, a bull market continues. It is a critical marker for a continuation of the bull market. You just don't see a 76% retracement and then a retest of new lows or retest of those former lows within the next year. So, our work would suggest very consistently the degree to which we've rebounded is a very bullish marker, at least historically. Now, every time there's a chance that this time is different. The one thing that is different this time is the lack of recovery in small caps. The other thing we've never seen in U.S. history is small caps recover so little of their peak to trough decline, while large caps are recovering so much. So we want to watch small caps really carefully, because I do think that is an area of risk in the market. If we can't get some participation from small caps, we can't get that positive signal out of small caps continuing to churn a bit higher, we could be in for a rocky road ahead.
And Gina, you've written about recently about how this sort of gloom coming into this year about the economy is really a distraction when you're thinking about from the point of view from an equity perspective and what it means when you're looking more towards what corporate America is signaling on the profit outlook. Why do you think this typically continues to happen when you look back in history, and potentially even just be a losing strategy for investors if they're obsessing over what the timing could be on a recession, when all of a sudden, when, especially like you were talking about, energy excluded from S&P 500 outlook really improving moving forward?
Yeah, this I think is so key for investors to really understand, and we were reminded of this all year this year. The economy and the earnings stream are not the same thing, and stocks trade on earnings and the outlook for earnings very clearly. We've seen earnings growth come in much better than anticipated. Like I said, less bad than anticipated, but frankly, earnings have improved considerably relative to what was priced in the equity market late last year. And that is really important, because the economists are still thinking, well, we may scale by without falling into recession, but there's still a lot of chatter about the macro outlook. Many people are still really wringing their hands over what's going to happen in the economy. And that really kind of misses the point, because there are commonalities, certainly. And if the economy does fall into recession, there will be pain points in the earnings stream that emerge. But for now, what is important is that margins appear to have formed a bottom. They're starting to improve a little bit here. We seem to be stable enough in the economy to create some stability in the top line revenue. For the index, we're always on guard for something to change, but those earnings are what really drive stock prices. And I think this is so important. Even the percentage share of industries' impact on the equity market is so very different than the percentage share of those industries' impact on the economy at large, that trying to use the economy as a forecasting tool for the market proves to be a really dicey business.
All right, Gina, it looks like we're back in the business, focusing on earnings, maybe a little bit less so on the Fed, and that's a good thing because maybe we get some earnings momentum here. Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us, giving us a great overview of the market as we kind of pour through these earnings, really kicking in this week in size, including today, and then well through the next couple of weeks. So maybe a little bit better than expected outlook on earnings. Just what to see how it comes in.
And you brought up the Dow Jones Industrial Average. Actually, heading in today, it had been up for 8 consecutive sessions. That was as long as winning streak in about 4 years. And so heading for potentially a 9th consecutive session. Nice. Also looking at more of those cyclical-oriented corners of the market holding up.
Yeah, you'd like to see that. And as Gina suggested, that's a good thing to see, a little bit of a broadening out from the tech, so that's good. We're going to have more coming up. This is Bloomberg. Right now, let's get some company news with Steve Rappaport.
Good morning, Paul. Shares of Netflix are down more than 7.5% after projecting a weaker than expected outlook. Bloomberg's Charlie Pellet reports.
It suggests a crackdown on password sharing and a new advertising strategy are not yet delivering the sales growth that analysts anticipated. Netflix's second quarter sales rose 2.7% to $8.19 billion, coming in slightly below analyst projections. That was due in part to foreign exchange rates and to price cuts in some markets. The company's forecast for third quarter revenue of $8.52 billion was also shy of Wall Street estimates, which average $8.67 billion.
Thanks, Charlie. Google is reportedly testing a program that uses AI technology to produce news stories. More on that from Bloomberg's Joan Doniger.
Steve, according to the New York Times, Google is pitching the program known internally as Genesis to various news organizations, including The Times, The Washington Post, and Wall Street Journal owner News Corp. Sources say the product takes information like details of current events to generate news content. One person familiar with the AI tool suggested it could serve as a personal assistant for journalists by automating basic tasks. Some executives pitched on the idea expressed concern. Google's product takes for granted the effort that goes into producing accurate stories.
Thanks, Joan. Pay now to save later. The Financial Times reports Wall Street's biggest banks doled out more than $1 billion in severance in the first half of this year. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start on the data front today. There apparently aren't enough homes out there to sell. Sales of previously owned U.S. homes falling to a 5-month low for the month of June. Blame a lack of inventory. That's also pushing selling prices near a record high. The median selling price for a home in the United States $410,200. The percentage of states showing a significant rise in jobless claims, that fell again, but that still does remain above the recession threshold. Dow Jones Industrial Average, as Justin Paul mentioned, that is higher right now. Leading the way there, you have shares of Johnson & Johnson and Goldman Sachs. Now, J&J raising its 2023 earnings outlook. And then you have the big drags for the NASDAQ 100. Right now, of course, Tesla, NVIDIA, Amazon, as well as Netflix after their earnings. S&P 500, 15 points lower. That's down 0.4%. NASDAQ 100, down 164 points. That's a 1% decline right now. And the Dow Jones Industrial Average, 141 points higher. That is up 0.4%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are also streaming on YouTube. You can head over to YouTube and search Bloomberg Global News, and you'll find that stuff right there. Let's talk about earnings here, and let's talk about healthcare earnings. We can do that with Ann Hines. She's from Mizuho Americas. She's a managing director and senior healthcare services equity analyst there. And thanks so much for joining us via the phone here. Healthcare services, give us a sense about how this group has traded over the last couple of years. Just give us a sense how investors and how you position the healthcare services providers out there to investors.
Sure. I would say this group has traded, it's a tale of two groups, mainly managed care and hospitals, and it's really based on utilization. Remember, during COVID, baseline utilization, that's what everyone refers to, healthcare utilization before COVID, was really below pre-pandemic levels. And if you go even further, if you do it by payer mix, whether it's commercial, whether it's Medicare Advantage, whether it's Medicaid, definitely Medicare Advantage and Medicaid beneficiaries were not seeking care. They didn't want to go to the hospital. Now we get to 2023, and it's probably the first year since the pandemic that trends are normal. People are going back to get to the doctors. They're going back to get elective procedures, hip procedures, things that they really postponed during the pandemic. That's really good for any provider. So HCA, big hospital companies, Tenet, Universal, Surgery Partners, I don't cover MedTech, but MedTech companies, any company that provides healthcare. It's been a little bit more difficult for managed care companies this earnings season, especially managed care companies that have exposure to Medicare, because it's the Medicare beneficiaries. They tend to use the system more, and they were the ones that really didn't want to go into the system during the pandemic. So we're seeing increased utilization, which is really hurting the stocks year to date, whereas you have the hospital providers that are really outperforming.
And to your point, I mean, looking at stocks like Humana, ticker symbol HUM, that's down about 13% year to date. Also looking over at what's happening with UNH, also down about 5%. But the other side of that, HCA Healthcare, that's up about 20%. And then Tenet Healthcare, looking at that ticker symbol THC, up almost 60%. How much longer do you think, when we're looking at those types of stocks like Tenet, and then also when it comes to HCA, how long and how much more room it could have for those stocks to keep moving higher?
I would argue there is room to move higher for two reasons. One, earnings, and I like to refer to baseline earnings pre-pandemic ex-COVID, they're still hampered because of labor costs. So to put it in perspective, before the pandemic, HCA spent about $990 million on temporary labor. And at the height of the pandemic, the company spent $2.5 billion. That's a 12% EBITDA headwind, a headwind to EBITDA. And if you annualize last quarter, it's still at $2 billion. So it's very elevated. So there's a lot of drivers for upside for a company like HCA and Tenet, because temporary labor is coming down slowly, but it's coming down. And then you also have this pent-up demand utilization that's coming back to the system. And if you look at Medicare, they were, I would say you have probably a 2-year window of people catching up with procedures that they didn't do during the pandemic.
So as you talk to your institutional investor clients, and what are the topics that come up the most? What do you find yourself explaining or kind of discussing with your clients?
Utilization. So it's all about healthcare utilization. but also pricing, what managed care companies price into their bids for 2024, and did it capture this utilization? I think all the companies expected utilization to come back. I think they probably expected it to come back more over 2023, 2024, and 2025. And a reason for that is nursing is an issue. A lot of nurses left the field. It caused capacity constraints. And I think what we're seeing in 2023 is more capacity opening that people probably expected. So I would think that's the main thing. And to your question, how long can the hospitals run? And I would argue companies that have earnings upside, they usually go up and not down.
So on the labor front, I mean, granted, I mean, you think back to the pandemic and the conditions under which all the healthcare providers had to operate. I mean, they're just, saints, every one of them. But as you mentioned, a high toll on turnover in that space. So is this an industry that just chronically is short on nurses and maybe to a lesser extent doctors? Is that something that's kind of a chronic issue for the industry?
To a degree, but what happened during the pandemic is that you have a permanent nurse that always works full time, and then you have nurses who like to travel. They get paid a little bit more an hour, but they tend to travel. And what happened during the pandemic, there was such a high demand. You had this phenomena that permanent nurses went temporary to get the higher hourly wage. Like, to put it in perspective, a nurse might make $50 an hour, but at the height of pandemic, they were making $250 an hour.
Wow.
I think what we're seeing is that some of these nurses that left their permanent position, they're coming back to full-time positions in the workforce. But there's also a part that the average age of the nurse is about 50. Maybe that nurse is working less hours, less shifts. So it's a combination of both.
And to Paul's point, because he was asking about some of the top questions you're getting, what about the top concerns among some of your clients as far as what this could mean as far as the outlook moving forward?
I would say the top concerns I get is on the managed care sector, because they have a few headwinds coming up. There's some changes to Medicare reimbursement that would impact Medicare Advantage plans. And the big thing is also Medicaid redeterminations, because I'm sure you know the Medicaid rolls swelled during the pandemic because of the public health emergency. States were not allowed to redetermine anyone on Medicaid, and that ended in April. And over the next 12 to 14 months, states will be rolling beneficiaries off, and that just causes a lot of uncertainty with numbers because a lot of these companies didn't benefit from the public health emergency.
All right, and top picks. What are you talking to your clients about? What do you like right here going forward?
So I would say a top pick on the managed care side are Cigna and Elevance. And Cigna for two reasons. One, they don't have a lot of Medicare Advantage exposure, so a lot of the changes to reimbursement is not going to impact them. And they also don't have a lot of Medicaid redeterminate exposure. So the two biggest worries in the managed care sector, they don't have a lot of exposure to. There is some risk with PBM legislation, but I would argue that's already based in valuation at about 10 times 2024 earnings. I still like HCA just because despite the run, there is a lot of upside to earnings, in my opinion, for 2023 and 2024.
And when you're talking about legislation, are there anything in particular coming up on Capitol Hill that you think investors should keep their eyes on when it comes to potential maybe regulations that could affect some of these companies?
Yes, so Congress wants to pass PBM legislation that will result in increased regulatory scrutiny on the PBM. So companies with the biggest exposure would be United Healthcare, CVS, and Cigna. That's pretty well known, but the question is if there's going to be a legislative vehicle. I believe there will be a legislative vehicle in December, and I'm also a believer that this has been a headline risk for a long time, and I think any type of legislation that passes will have not go into effect to 2026, which will allow these PBMs to change language in their contracts. So when all is said and done, I actually don't think it will have a meaningful impact on EPS, and it should remove a headline risk. And we should get more details on that, but not until December. But that's the major thing, because typically in healthcare, when there's a balance of power in Washington, not a lot of healthcare legislation is passed.
Hey, and just about 30 seconds here. Drug distributors, you're neutral on that group. Why?
Really valuation. They've had a great run for a long time, and they're reaching their 10-year highs. Earnings visibility is very good. But I do think it's a crowded sector. It's a sector that a lot of journalists went in over the past couple of years when there was a lot of uncertainty in the market. But they are great companies, and it's more valuation than anything.
All right, Ann, thanks so much for giving us some of your time. Ann Hines, Senior Healthcare Services Equity Analyst. She's a Managing Director over at Mizuho, putting out some good work talking about the healthcare space. A lot of these stocks have had some good runs. And now, as Ann was saying, getting into a little bit more of a normalized operating environment here past a pandemic. People actually going back to the hospital and getting some of the procedures that maybe they pushed off during the pandemic. S&P 500 pretty much lower, about 0.4%. Right now, let's head down to Washington, D.C. We're going to world and national news with Nathan Hager.
Paul, Ukraine is warning that any ships headed to Russian ports or in occupied areas of Ukraine may be considered military targets. This is a tit-for-tat response to a threat from Moscow that sent wheat prices higher this week. Meantime, officials in Ukraine tell the Washington Post their forces have begun firing U.S.-supplied cluster munitions into parts of southern Ukraine that are part of well-fortified Russian positions. Bloomberg's Anne-Marie Horton reports this brings the war to a new phase.
The speed at which these cluster munitions were announced by the administration just about 2 weeks ago to then being used today is pretty rapid.
Bloomberg's Anne-Marie Horton in Washington. The U.S. says North Korea still hasn't responded to attempts to discuss the American soldier who crossed the border into North Korea this week. Private Travis King ran in after finishing a prison sentence for assault in South Korea. State Department says it has reached out to South Korean and Swedish officials who've served as liaisons with the North in the past. The U.S. can also reach North Korea through a UN hotline known as the Pink Phone. Heat waves around the world are getting more intense. The temperatures are flirting with all-time highs in Greece, where wildfires have forced thousands to flee their homes. That includes this woman who says there weren't any firefighters around when the flames reached her property near Athens.
The situation is horrible because we didn't have any help. We was by ourselves and we was trying to save some things from our house, but we didn't have time.
She spoke with ABC News. Here in the U.S., heat watches and warnings are in effect from California's Central Valley all the way into Miami, where the heat index has been above 100 degrees for 39 straight days. It'll feel like at least 105 for nearly a quarter of the U.S. population into the weekend. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Dow Jones Industrial Average rising. Well, the S&P 500 and the NASDAQ 100, they're lower. The Dow getting a boost this morning from J&J. Johnson & Johnson raising the earnings outlook for this year. Among the stocks weighing on the NASDAQ, Tesla, after its disappointing results. Joe Quinlan at Bank of America Merrill Lynch says despite some disappointing earnings, this is not the time to avoid equities.
What we're going to see is some of this air come out of this, the big seven. That'll drag down the indices here. Everyone knows what's been pulling them up, and we know what's going to pull them down. So don't be surprised if there's some tech consolidation over this earnings season. That does weigh on the overall market. But this is a good time for look to other areas, whether it's energy, healthcare. There's other places to put money to work in the market.
Right now, the NASDAQ 100, 232 points lower. That's a decline of 1.5%. S&P 500, 21 points lower. That's down 0.5%. 45.43 on the index. And the Dow Jones Industrial Average continues its winning streak. 184 points higher. That is up 0.5% right now. 35,246. Let me check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business. Why are you smiling?
Thank you, JT. We appreciate it. No,
some
you're
good
always
news.
cracking me up about
Okay.
you talking about how you're a cynic
Jess is
earlier.
always smiling. That's, what
She
one of
is.
many
That's
things
why
love
we
about
have her here.
Yeah, that's right.
Jess Mitten, Paul Sweeney here, back once again in the Bloomberg Interactive Brokers Studio. We want to switch things up for our next segment and do an energy outlook. And I'm excited because we do have in studio here Jonathan Maxwell, who's CEO at Sustainable Development Capital, who's joining us to discuss the outlook on oil and the renewable energy markets, particularly with the growth of Tesla this year and the emergence of EVs. But before I actually get into that, I have to ask you about Ukraine. And we're seeing wheat prices soaring today. It's actually their 3-day gain is more than 10% after the U.S. did warn that Russia has laid mines at Ukrainian grain ports. Now, you've written a book recently tied to Ukraine. What's your take on this, and how does this mean, and what does it mean for the energy and commodity space?
I think it has a huge story around resources and conflict over resources. Ukraine was really the conduit prior to the Russia-Ukraine crisis for Russia's exports of oil and of gas into Europe. It was piped through Ukraine. Europe needed to get 40% of its gas from Russia. That's over. Yep. We saw energy prices skyrocket last year. We saw energy in Europe. We saw energy security become front-page news in a way that it never had before. So the link between Ukraine and resources was the big headline last year was energy. Now, there was a deal struck which kept grain exports and other really critical resource exports going out of Ukraine. But Ukraine is one of the most important resource stories in the world. After America became energy independent in 2019, really this resource arena has shifted now into Eastern Europe. You know, Russia and Ukraine are really the nexus for the balancing demand around, or supply and demand around oil and gas on the one hand, and other resources like grain on the other. So what we're seeing is a conflict which is partly driven by conflict over resources, but also it's having a dramatic impact on pricing.
All right, so at Sustainable Development Capital, you guys look at kind of, I guess, this challenge about being sustainable, being eco-friendly a little bit differently. Talk to us about the types of investments you make there. What do you like to, where do you think you can add value?
Right. Well, one of the major responses that came up, tying it back to Russia-Ukraine, one of the major responses that happened last year is, given the fact that energy was being constrained in Europe, what should we do about it? So what? So there was a huge response, build more energy, add more into the system, mostly renewable energy, until it became clear how long that would take and how much money that would take, and the fact that that wasn't going to address energy security in the short term. In fact, there was an echo of the European Commissioner for Energy's response from the 2014 invasion, which was really important in Europe last year. They said for every unit of gas that we don't use, is 2.6 units of gas we don't need to buy from Russia. So the implication was actually we're wasting so much energy, and so about 70% of energy gets lost somewhere between getting extracted and used.
All right,
but
stop.
if we can stop that,
That's the number I like. That's because I remember that from last time. Say that one more time slowly for.
Yeah, so in the United States, the Lawrence Livermore National Laboratory has charts each year, produced every single year, that show how much energy gets lost from the point of extraction to end use. About 10% gets lost extracting and converting it. About 50% gets lost in heat, because energy is generated typically in one place and used in a very different place, and you can't do anything with the heat. And then another 10% gets lost in transmission and distribution. This is the basic fact of the way that we've done energy, centralized energy systems, not just in the US, but in the UK, Europe, everywhere. And that is the part of the problem that needs to be solved. Here we are trying to add more energy into the system, but the system's broken. It's unbelievably inefficient. And if we can generate energy close to or at the point that's needed, and stop wasting so much at the point of use, 10, 20% plus is typically wasted at the point of use. That's one of the most important, largest sources of productivity, economic gain, let alone carbon emission reductions available on Earth.
So then what is the key to reducing energy waste to meet climate goals ultimately?
So I think the first point is generate energy where it close to or at the point of use. So let's look at the big problems, right? Electricity is being greened, which is great, but it gets used mostly in a residential context. If you look at industry, 85% of industry is driven by fossil fuels, 98% of transport. So what can you do about that? You can generate the energy close to the point of use. So even if you're using natural gas, capture the heat and use it for heat processing in industry. If you can do that by recycling waste gases, on one of our funds, we own a huge recycling project up in Indiana, Gary, Indiana, where we recycle flue gases and use that to power the steel mills. So these sorts of solar on-site storage is a massive part of the solution. The second part is actually just stopping wasting so much inside of buildings: motors, controls, lighting. These are heating, ventilation, air conditioning, cooling as the warm weather heats up the world. So these are the things that are going to make a tremendous difference and can be done quickly. It takes years to build a new renewable power system. We need to do as much of that as possible, but it takes months, maybe a couple of years, to do any of the things that I'm discussing in terms of generating energy on site or indeed reducing demand for it.
So what's a recent investment that your funds have made that you're very excited about?
So I was in upstate New York yesterday. We own one of the largest district energy systems in the United States, and that provides energy on site to 120 customers in Rochester Business Park. We own an investment in a company here in Manhattan, which is called Onyx Renewables, which does solar and storage nationwide. And that produces on-site generation on people's rooftops, carports, or in the ground, but connected directly to buildings, producing low-carbon, low-cost energy solutions. On the electric vehicle side, this is a huge opportunity. Electric vehicles, around 80% efficient versus about 30% efficient.
And so 80% efficient versus 30% efficient for internal combustion.
Yeah. So
how do you define that? Like what's efficient?
Right. So if you track the energy, the primary energy coming out of a well, what they call well to wheel, and you track the journey of the molecule to exactly what survives through the engine,
okay,
it gets lost through the generation, transmission, etc. It's roughly 30% in an internal combustion engine. What they call wind to wheel, that is taking the electricity out of a renewable power plant, and the electricity broadly survives to get into the car, and then that is then converted into power that actually goes along and moves this vehicle along. So it's very efficient. It's also, frankly, yes, it will help reduce demand, hopefully, and displace fossil fuel use, but it also cuts pollution in town. So even if you're not into the climate and you're not into ESG and you don't like greenwashing or greenhushing, then surely you don't want your kids to grow up in cities that are 3 or 4 times the level considered safe by the World Health Organization, like my hometown of London, because of the cars, taxis, and buses. So it's those sorts of things where you've got efficiency combined with better outcomes for people.
We're having you back. The next time you're in New York, I know you said you're back here a lot. When you're back in New York, we're going to continue this conversation. Jonathan Maxwell, CEO, co-founder, Sustainable Development Capital. I like the capital part.
Book out in the U.S. in December.
Very good. This is Bloomberg. Coming up, let's get some company news with Steve Rappaport.
Paul, it's a tough start to the trading day for Tesla. Shares are down after the EV maker fell short of expectations following months of price cuts. Tesla also warning of more hits to its shrinking profitability. Let's get more on that from Bloomberg's David Welch.
The amount of margin slippage in the quarter wasn't bad. These were overall pretty good numbers. But investors are looking ahead, and Tesla's not committing to that the way they typically have. And I think investors are just saying, okay, if they're not committed to industry best margins, then profits are going to be under pressure going forward.
Thanks, David. Shares of Tesla down now more than 6.5%. It's back to the bargaining table for UPS and the Teamsters. The latest on that from Bloomberg's Jeff Bellinger.
Steve, talks broke down July 5th after Teamsters negotiators rejected UPS's offer on wage increases for part-time employees. The union says UPS bowed to the overwhelming show of Teamster unity and reached out to resume negotiations next week. The current contract expires at the end of the month, and Teamsters President Sean O'Brien vowed that union employees will not report to work beyond that without a tentative agreement. UPS, in a statement, said it is pleased to return to the table and the company is prepared to increase pay and benefits. Steve?
Thanks, Jeff. Shares of UPS up less than 1%. Johnson & Johnson stock gets a boost after the company raised its earnings outlook for the year by 10 cents a share. Johnson & Johnson raised the outlook after its medical devices unit outpaced expectations amid a comeback in procedures that were put off during the pandemic. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio, looking at these markets kind of red and green on the screen. The S&P off about 0.3%. NASDAQ taking it on the chin off 1.3%. Some of those tech numbers coming in a little bit light. Dow Jones Industrials up 0.75%. Looking at the yields, we got a little bit movement up in yields. 10-year Treasury up about 9 basis points. 3.84% on your 10-year. 4.86 on your 2 years. So still got that 100 basis point inversion there. We'll keep an eye on that. Oil pretty steady. WTI about just under $76 per barrel. Right now, let's head down to Washington, D.C. We'll get world and national news, and we'll do that with Nathan Hager.
We got some breaking news that might matter to you if you plan to fly anywhere in the next few years. The House has approved a bill setting aviation policy for the next 5 years. The vote was 351 to 69 on the bipartisan Federal Aviation Administration Reauthorization Act. This is a bill that includes provisions aimed at alleviating flight disruptions, boosting funding to airports, staffing up air traffic control, and raising the pilot's retirement age. It's going to take a few months for the House and Senate versions of this bill to be resolved. The Senate does have its own FAA authorization, but it's been stalled in committee. House Republicans are holding a hearing right now on what they see as government censorship online. The GOP-led Subcommittee on the Weaponization of the Federal Government is hearing from Robert F. Kennedy Jr., the Democratic presidential candidate, whose claims about vaccines have been under White House scrutiny.
I've never been any vaccine. But everybody in this room probably believes that I have been, because that's the prevailing narrative.
And one of Robert F. Kennedy Jr.'s latest claims is that Asian and Jewish people are less susceptible to COVID-19. Kennedy says he is not an anti-Semite. The Senate Judiciary Committee votes today on new ethics rules for the Supreme Court. This comes after recent revelations that Justice Clarence Thomas took luxury vacations and did a real estate deal with a Republican megadonor, and more recent reports of undisclosed money-making ventures for Justices Samuel Alito and Sonia Sotomayor. The legislation is expected to pass the committee, but it has little chance of making it through the full Senate. Could see charges soon against former President Donald Trump in the special counsel investigation into January 6th. That's what we heard from Trump this week. He's saying he was told Sunday night he was a target and given 4 days to appear before the grand jury. That would be today. House Speaker Kevin McCarthy is defending the former president.
I don't see how he could be found criminally responsible. He did not charge it. Well, what criminal activity did he do? He told people to be peaceful.
But former New Jersey Governor Chris Christie, now running for president, has a warning for the speaker.
I would counsel Kevin that he should wait to see the indictment first before he jumps to any judgments. Now, it could be that Kevin turns out to be right. Maybe these charges are completely bogus and political, like the ones that Manhattan were.
Referring there to the hush money case from Alvin Bragg, the Manhattan District Attorney. Chris Christie was a guest on Bloomberg's Balance of Power. You can hear that entire interview on the Bloomberg Talks podcast. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Jess.
Nathan Hager, thank you so much. We appreciate it. Jess,
Powerball.
$1 billion.
Do you do the Powerball, Paul?
We did, but I'm assuming we didn't win, because I think I would have gotten a phone call.
The winner in Los Angeles?
Los Angeles, right? And apparently that store is a pretty good store to win stuff at.
Yeah, Las Palmitas, a mini market in Los Angeles. Yeah, it turns out to be one of the best places apparently in the country to actually win the lottery.
And guess what? California does not tax lotto winnings.
So it's subject to a 37% federal income taxes as well as state and local taxes depending on the location of the winner. But California may have some of the highest personal income taxes in the country, but it's one of the few states that does not tax lottery ticket wins.
So you take off, let's just take off 40%, so it's $600 million, maybe a smidge less for the lump sum thing, but still.
Where would you go with that?
It's a good amount. Yeah, what would you do?
Treasuries or?
Treasuries?
Oh, I see what you're saying.
Yeah.
Oh, no, I'd throw it all, go down to Vegas, put it all on black.
Really?
It's okay.
Exactly. Who knows? My goodness. But yeah, it'll be interesting to see who the person is and kind of how it plays out, because there's so many stories of it not working out well for the
That's
people.
true.
And that's
a lot
so
of
sad.
gloom
You want them to
stories.
just kind of take the money, relax, enjoy life, buy a house for mom or something. I don't know. We'll see how it plays out. This is Bloomberg.
Never does turn out well, does it?
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Joe Matthew, host of Bloomberg Radio's Sound On and Bloomberg TV's Balance of Power. He's going to join us to discuss the interview he and Anne-Marie Horner had with 2024 presidential hopeful and former New Jersey Governor Chris Christie. So that'll be coming up in just moments. Plus, we're going to check in with one of our faves, David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management. How is he playing this market? Is he enjoying this 18% move we've had in the S&P 500 year to date? So we'll check in with all that. But first, let's kick it off with John Tucker on Bloomberg Business Flash.
All right, thanks, Paul. Netflix looking at the biggest drop this year after projecting third quarter revenue that fell short of estimates. Right now, that's the biggest drag in the NASDAQ 100. The NASDAQ 100 is down right now 216 points. That's a decline of 1.4%, 15,608. S&P 500, 15 points lower. That's down 0.3%. The bucking the trend, Dow Jones Industrial Average up 270 points, a rise of 0.8%. The biggest gainer there in percentage terms, that would be Johnson & Johnson. Stuart Kaiser of Citigroup Global Markets, he still sees a positive backdrop for his stocks.
The last inflation print was quite low, and we're kind of on a bit of an easing trend on inflation, and the Fed is, seems comfortable hiking slower or being completely done. And I think if you put all that together for risk assets, that's been a really powerful combination.
And underscoring that, most economists surveyed by Bloomberg do expect the Federal Reserve to lift rates one more time. That'll be at their meeting next week. And then they think they are done. But wait, on the front end right now, two-year yield close to 11 basis points higher, 487 right now. You can credit the initial jobless claims figures. So we saw an unexpected drop in the claims numbers this morning. So that's behind that rise in yields this morning. As for the 10-year, that's up 10 basis points. It's at 384. We'll check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Metton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on the YouTube thing. Just head over there and search Bloomberg Global News. You'll find us. Looking at the Dow Jones Industrial Average, again, up 275 points, as John was just reporting. Who are the contributors? Johnson & Johnson. That's adding 67 points. New Jersey-based company, by the way.
Also want to point out it's just a little bit 4% below its all-time high.
4%?
Correct.
Wow.
Exactly. And then also our friend Elena Papino, we had been talking about the winning streak for the Dow coming in today. Now, if you look at today, which it potentially would put it on 9 consecutive days of gains, it would be its longest winning streak since 2017. So our buddy Elena Papino on our equities team pointing that stat out.
Good stuff. As Tom Keene says, the courage to be in the markets. I know who's in the markets. Bloomberg Equities reporter Alexandra Semenova. She joins us here in our Bloomberg Interactive Broker Studio. Alexandra. What did I say?
Alexandra.
Sorry, Alexandra.
Or just Alex.
Semenova. Yeah, Alex. What do you see in the markets today, Alex?
Well, first of all, so good to be on with you guys today. Happy Friday Eve. I know the big story is big tech with Netflix and Tesla kind of taking some of the shine off of the NASDAQ 100 today, but I'm a glass half full kind of person, so I'm looking at United Airlines. Shares were up about 1.7% the last time I checked after the airline raised the low end of its profit forecast for the year and said that it would earn more money than Wall Street analysts had expected. Like its other airline peers, it is benefiting from this pent-up post-COVID travel demand, particularly with international travel. I know we were talking about this yesterday. I just came back from Europe. It's showing no signs of abating. I mean, all my flights were just packed to the brim. You can see consumers really wanting to buy airline tickets, even though the costs are higher. So companies like United Airlines benefiting from that. That also kind of echoes results from Delta Airlines last week, which also said that it will make more money this quarter than analysts expected. There was an interesting stat from Deutsche Bank. They estimate that a group of 11 U.S. carriers is expected to report a record $58 billion in revenue in the second quarter. So really reflecting that robust travel demand. Also interesting because everyone is talking about a recession and consumers are showing no signs of slowing down spending.
Yeah, I'm not buying the whole recession talk. I mean, everybody's got a job who needs one. It doesn't support a recession.
Also, looking over at what's happening with American Airlines, ticker symbol AAL, those stocks down more than 5%. But also, when you look at what this industry group in the S&P 500 has done this year, up more than 30%. So in general, I mean, these airlines have been on a tear. And so to Alex's point, when you're looking over at United, also Delta, and obviously your daughter traveling all over, globetrotting the world, clearly that things that are rebound to that international travel demand in particular, especially when we've talked to analysts at Bloomberg Intelligence this week talking about how it's a little bit different domestically this year when you're looking at the airlines versus internationally.
Yep. What else are you looking at, Alex?
So the positive narrative around inflation and the prospect of a soft landing continues to kind of lift stocks. Not today, but we are set for a higher week so far. You have Deutsche Bank's Peter Hooper this morning with an interesting note. He said that previously the expectation was that the Fed would have to break something, would have to trigger a recession in order for inflation to come down. And now he's saying that it's a bit of a toss-up. There's a lot more uncertainty about whether a recession is inevitable. There was also an interesting stat this morning. Breadth has significantly improved. Obviously, it's been a big concern that big tech is kind of the only sector driving the market higher. But 168 stocks in the S&P 500 are trading just 5% from their 52-week high. So it's really a sign that some of the laggards are catching up. We are seeing the rally start to expand a bit, and it's offsetting some of the concerns around narrow leadership.
What are you seeing when it comes to sort of the latest takes on strategy? Because I know you were pointing out earlier this week, especially when you're looking at someone like Marco Kolanovic over at JP Morgan, sort of changing a little bit of his tone compared to what he's been talking about recently, and maybe a bit more of a capitulation, a little shift. And we saw that with Credit Suisse this week earlier, too, raising their price target for the S&P 500.
Yeah, absolutely, Jess. It's very interesting to hear someone like Marco Kolanovic kind of soften his stance on a recession as well, because he's someone who's been warning investors to stay away from stocks, saying that there's still a lot of risks from central banks and the prospect of an economic downturn. But earlier this week, that he said that June's CPI report actually kind of broadens the path to a soft landing. Very notable from someone like him who has been pretty pessimistic all year long. You also have Jonathan Golub at Credit Suisse raising his target for the S&P 500 index to 4,700 from 4,050. A big change there, compared to when he was heading into the year, and there was this expectation that stocks would be relatively flat. So we're seeing a lot of strategists trying to play catch up because, there is this pressure from their clients, when they missed out on a rally that no one saw coming.
Exactly. That's what it feels like. It feels like a lot of the, well, not just the strategists, but I think a lot of fund managers and just, commentators on the market, didn't see this rally coming to the degree that it is. Again, up 27, 28% off the low, up 18, 19, 20% just year to date in the S&P, even more in the NASDAQ. Just didn't see it coming here.
And especially with your breadth of experience being on Wall Street, obviously since the mid 80s, if you're wrongly positioned for that, especially as a portfolio manager, and the S&P 500 touched that low back in October, at what point are you potentially out of a job if you don't square that away and your clients are coming to you asking about, hey, why is my portfolio not up XYZ at this point?
Right, and that's kind of momentum investing here. If I'm behind here, I have to chase the indexes. I have to chase the bogey. And how do I chase the bogey? I probably just start buying Apple and Amazon and doing that and hope that train keeps rolling. Or, but what we've heard from a lot of fund managers is that they're looking for places that haven't run. Maybe there's some value. Maybe some of the sectors, whether they're industrials, if you listen to Gina Martin Adams, some of the more cyclical names that would benefit or will benefit if, in fact, the recession is a soft landing. Or, in fact, if we, in my case, in my belief, we avoid a recession, maybe that's the way to play it.
Yeah, even Mark Kolanovic in his notes said that he sees some room for upside in small and mid-cap stocks, which again is a big change in tone for him. He sees that happening if inflation comes down to 2.5% and we see rates coming down. So that could be a factor that could drive some of those other names. And of course, a lot of folks also talking about the equal weight S&P 500 doing better in the second half of the year because those stocks are trading 15 times earnings compared to the Magnificent Seven trading at 40 times earnings. So there's a lot of opportunity there.
Yeah, that's that. All right, Alex, thanks so much for joining us. As always, Alex Semenova, she covers all the markets for Bloomberg News. We appreciate getting her here in studio. Let's head down to Washington, D.C. Joe Matthew, radio and TV host, Bloomberg's Sound On and Bloomberg's Balance of Power, joins us. Joe, you and Anne-Marie Horton interviewed Chris Christie on Balance of Power last night. Here's a clip of your discussion.
At our nation's secrets, hanging out at Mar-a-Lago and at his Bedminster Golf Club. Think about the risk that puts our men and women in uniform and our intelligence officers at.
That was former New Jersey Governor Chris Christie. He's also a presidential hopeful for 2024. Joe, talk to us about kind of some of the highlights from your discussion with Mr. Christie.
Well, we tried to take a different approach, as you might have noticed, because every time I see Chris Christie or hear Chris Christie in an interview, the entire thing is about Donald Trump. And of course, you have to ask him about the front runner. But we tried to be a little bit different here for our audience on Bloomberg and actually talk about a couple of issues. I've never heard him be asked about the economy, about inflation, his thoughts on Jay Powell, his thoughts on geopolitics, how he would handle China, his thoughts on Taiwan, a lot of things that we frankly learned for the first time in that conversation last evening. And we got to take a pretty deep dive with him on a number of issues here. So yeah, when it comes to Donald Trump, look, he's a former prosecutor, and his view is that we have already seen what could be the most damaging case against him, that cut that you just played. He's talking about the classified documents case, and he sees that as the most damning legal action that the former president is facing right now, even as we wait for yet another indictment likely to drop, according to Donald Trump, in the next few days.
How do you think this shapes up for the race for the election, especially when you're looking at this latest poll from Reuters where it has Trump up about 47% of support among Republicans, and then you look at DeSantis at about 19%, and kind of what you think this could mean as far as from a sentiment perspective?
Well, first of all, I would just caution everybody to throw a little bit of salt at, more than one grain at any national poll right now, because if I bring you back to where we were in the race in 2016 right now, you'd be asking me when Jeb Bush was going to move into the White House. Right. You'd be asking me when Scott Walker might be doing the same thing. Donald Trump, I believe, was around 4% at that point. Now, we cannot argue with this remarkable lead, this powerful lead that Donald Trump has at the moment. You're asking the right question about number two, though, and we're watching Ron DeSantis attempt to reset his campaign. He actually laid off some workers, found himself spending too much money, and hard to rationalize a polling data set that's been dropping essentially since he announced officially that he was coming into the campaign. So Ron DeSantis is dealing with an identity issue right now. He's trying to go out there and do more mainstream media, talk to people other than those who agree with him. And it's really, frankly, unclear. He's got a massive apparatus and a lot of money, but it's unclear that he can catch up to Donald Trump at this stage of the race. It's going to require an event. And I'll remind everybody there's a big one next month, and that's the debate, the first Republican debate that'll be in Milwaukee that the RNC is running. And by the way, the aforementioned Chris Christie is among candidates who made the cut to go on that stage, but so far has not taken the pledge, as the RNC is asking everyone to support the eventual nominee. Because if you're Chris Christie, you can't say you're going to vote for Donald Trump if he does this again.
Right. Interesting. All right. So, Joe, based upon your discussions with Anne-Marie and the governor last night, what do you think Governor Christie views as maybe his strategy going into this election? A lot of folks are just suggesting he's nothing more than someone to just beat up on Donald Trump. But what did you learn last night?
I'm glad you asked that. It's the first question that I asked him. Everyone knows that you're here to you're the guy who's here to punch Donald Trump in the nose rhetorically. That's your brand. And many would argue, by the way, there would never have been a Donald Trump without Chris Christie. Remember, he was the tell it like it is candidate. Now he's facing somebody who actually became president on that idea. But there needs to be more than that. And when I asked him about what is it that, beyond anti-Trump, what is your brand? He said one word: truth. I'm the only guy up there who will tell you the truth. Now, when you put that against some of the policy positions that we discussed, you might actually have a package there that a voter could consider. But when You're looking at him between 6 and 8% in the polls right now. He has yet to connect the dots with voters in that way.
Have we heard from the Biden administration about Trump's legal woes right now?
They're really